Okay, so we will start now. So the new chapter which we are going to start now is capital gains. So there are five heads of income. This is the fourth one. Very interesting and very logical head. And content wise also it is very rich. Too many things are there to be studied and to be remembered. And as far as this examination is concerned, this particular head has many amendments this time. Okay, so hence it becomes important for us to understand this particular head properly. Okay, uh, yes, partially indexation is there. Okay, but now it is taken away. From next year onwards, it will not be available only. But this year, for your attempt, it is partially. For some time it is available, sometimes it is not available. That we are going to discuss. Okay, don't worry. So let's start with the head. Okay, see, pay attention. Name of the head: capital gains. Okay, so like we divided the entire PGBP head into five parts. No, we will also divide this head into five parts. Okay, so the first part is basics that we are going to learn. Then second part will be specific charge. Next will be special aspects, and next will be exemptions, and last but not the least, tax rates. Okay, so first is basics, second is specific charge, third is special aspects, next one is exemptions, and last one is tax rates. So the rates of tax are different for capital gains. Okay, so that is the reason why we are supposed to consider the tax rates separately over here. Okay, and okay, one by one we'll start, and we'll come to know, we'll realize that how everything is there. Sure. So first part is basics. In our basics, no, today's lecture and tomorrow's some part of the lecture will go for basics. Once we'll complete this part, no, we'll be able to solve the basic questions on capital gain, basic things, and this thing should be very much in your control, because the other things, meaning the other parts of the chapter, the foundation for those things lies in this particular first part. Okay, so we'll start first thing with basics. Okay, so capital gain head has sections 45 to section 55A. Okay, these many sections are there. So since the number of sections are really too many sections, hence the chapter is divided. That is the reason why the content is too much. Okay, so first thing first, We are going to start with basics. Basics. Now in basics, now, first thing is charging section. Section 45, which talks about basis of charge. Basis of charge or also charging section. Okay. Now this has two parts. One is general charge, another one is specific charge. General charge, which is given in 45 subsection 1, and another one is specific charge, that is given in 45 1A, 45 1B, 45 2, 45 3, 45 4, 45 5, 45 5A. Now out of all these sections, 1, 2, 3 and 4 are not there in your syllabus. So we are not going to touch them. What specific charge sections are there in your syllabus? Only 45 1A, 45 2 and 45 5. This will be the second part of the chapter. Okay. But along with this, additionally, we are going to do section 46 and 46A also. These sections are also supposed to be done. These sections we are going to do. Okay. So this will be the second part of the chapter. Let us not, discuss about that. But we are going to discuss about the general charge. Okay. So this general charge, no, section 45(1). This says that any profit and gain arising on transfer of a capital asset will be taxable under the head capital gains. Yes or no? So first of all, the profit and gain will be chargeable under this head, arising on transfer. Transfer of what? Capital asset. So how to determine this profit and gain? You learn that under section 48. What is the meaning of transfer? Given in section 2, subsection 47. What is capital asset? That is given in section 2, subsection 14. So these three things we are supposed to learn first properly in detail. Okay. So first we are going to learn what is the meaning of capital asset, then what is the meaning of transfer, then we are going to learn that how the profit and gain will be computed under this head, because the computation of the profit and gain will happen only if you transfer a capital asset. So it becomes important for us to know what is transfer, what is capital asset. Only then we will be learning. Only then we will be required to compute the profit and gain. Yes or no? So computation will not happen if these two things are not present. Any one of the things are missing. Capital asset is there, but no transfer is there. profit and gain cannot be calculated. Okay, transfer is happening, but transfer is happening for an asset which is not a capital asset. Then also the profit and gain cannot be computed. Yes or no? So this profit and gain will be calculated. This profit and gain will be calculated only if there is a capital asset which is getting transferred. Now when this capital gain, when this profit and gain will be chargeable, when it will be taxable, that is also given under section 45(1). So section 45(1) says that this profit and gain will be taxable for you as income under the head capital gains, and this will be taxable in the previous year in which capital asset is transferred. So the year in which the capital asset is transferred is the year in which the capital gain will be taxable. But the taxable amount of capital gains will be after claiming exemptions, if any, under section 54 to 54 GB. So there are certain exemptions which are given under section 54 to 54 GB. After claiming those exemptions, whatever taxable capital gain is there, that will be taxable, and that will be taxable only in the previous year in which the capital asset is transferred. Okay. So now one by one we will do the post-mortem of all these things. What is capital asset? What is transfer? Then once we learn those things, then we are going to learn what is the how to calculate the profit and gain. All these things we are going to do one by one. Okay. Only then we will be ready to solve the questions, basic questions on capital gains. And once we have a good command over the basic calculations of capital gain, only then you will be able to do specific charts, special aspects, exemptions, and then finally tax rates will have some meaning, because tax rates are to be applied on capital gains, and if you don't know how to calculate capital gains, what will be the use of tax rates? Getting my point? So the entire exercise we are doing to calculate capital gains, on which we are supposed to apply special type of tax rates. By applying those tax rates, we are going to calculate the income tax liability which we are supposed to give to the government. Okay, now pay attention. One by one, slowly and gradually, we will discuss about what is capital asset, then transfer, and etc. So first thing which we are going to do is what? Meaning of capital asset. Meaning of capital asset. So if you all can see, capital asset is defined under section 2 subsection 14. Now it has two parts. Capital asset means something, and they are also saying that the capital asset does not include the following. So first, few things are included in the definition of capital asset. Then they are removing few things from the definition of capital asset because by mistake they have included. Okay. So why the bloody hell they are including first? See, the definition is so robust now, so wide enough that it covers almost all the assets, all the properties belonging to the assessee. Because the definition says that the term capital asset means asset or property of any kind. What is the meaning of any kind? Any kind means any kind. It can be tangible, it can be intangible. It is a capital asset. It can be movable, it can be immovable. It is a capital asset. It is fixed or circulating, whether used for business or not. Everything, every property, every asset which you have is a capital asset. Meaning that they have covered everything. See, indicating one by one that okay, this is asset, this is asset, this is capital asset, this is capital asset. First cover everything. And the things which we don't want to know, we'll remove them one by one. So there are less chances that we forget any asset on which we want to charge what? Capital gains. They're very smart. So first they included all the assets. Okay. Any type of assets. Tangible assets will be capital asset. Yes. Intangible assets, capital asset. Movable, immovable, fixed, circulating, whether used for business or not, will not make any difference. If you have any type of property, any type of asset, that is a capital asset. Done. Now, two things are specifically included. Number one, any shares or securities held by FIIs, foreign institutional investors. Even those shares or securities will also be treated as capital asset for the purpose of Income Tax Act. See, usually we see that any shares or securities which are held by FIIs, usually they are stock in trade for them. Because what are FIIs? FIIs are foreign institutional investors. Big, huge financial institutions of some foreign country. Okay. Financial institution means banks, mutual fund houses, insurance companies, huge organizations, huge financial institutions of foreign countries. When you see those institutions, you'll come to know they have huge amount of money with them. What they do with that money, they go in the capital markets of different countries and invest their monies in the capital markets of foreign countries. So for example, if I talk about US, so there are many big financial institutions of US. What they do? They have huge money. They go in Mexico, they go to Brazil, they go to Bangladesh, they go to India. In every country they will go. Wherever there is growth potential, in every country they will go and invest in the shares and securities of that country, of companies of that country. Yes or no? They will buy shares, they will buy securities, they will buy debentures, they will buy bonds, blah, 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 many things. And when they will be buying, the prices will be very less. At the time when the prices are very less, then they will enter in the market. They will invest in these shares and securities. And when after some times the prices are good, they know that if we sell it, we'll be making profits. So that time they sell their shares and securities and they move out of the market. Now next time they will find out some other country. In those countries, again in the capital markets of those countries, they'll go invest their money in the shares and securities at a very low price. They have a huge research team which is very effective and very knowledgeable research team which sits in those institutions headed by a fund manager. So the entire big institution is there. There will be a fund manager who will be handling the entire team of experts, finance experts. They'll be researching day in and day out about the capital markets of different countries. Okay, in India, these companies are very lucrative to invest the money. Okay, in Mexico, these companies' shares are very available at a very cheap price. So they'll be doing thorough research, and based on the research, based on their expertise, based on the knowledge of that entire team, this fund manager, this institution through the fund manager will go and invest their money in the capital markets in thousands of crores rupees. Now what will happen, for these companies, these big financial institutions, this is their business only, because they have huge money which they might be getting from their depositors, which they might be getting from their policy holders, okay, which they might be getting from their investors who are unit holders, etc. So the money which they are getting, their business is to get money and invest and earn returns for themselves and their investors. Their business is, this model of doing business is that only. Will collect huge sum of monies, invest somewhere, earn good returns, and keep something and distribute the returns to the investors. Now while doing this, what they do, they buy and sell securities. Buy and sell securities. Buy and sell securities of companies of different companies. So for them, the buying and selling of these securities, shares and securities, is the main business activity only. And in their main business activity, these shares and securities which they are buying and selling are their stock in trade, my dear friends. Because their business is to buy such securities and sell. Buy such securities and sell at a profit. Getting my point? So their intention to earn profits. Profits will be earned by buying the shares and securities of companies in different countries. So what will happen? Tell me. Yes, for domestic it is, yes, PGBP. But to attract FIIs, it is compulsory that we make their shares and securities as capital asset and not their stock in trade. Why? For these financial institutions, foreign institutions, their PGBP income is a normal income, which is taxable for them at normal rates. See, normal rates of a foreign country, do you remember? It was 40%. Right now it has brought down to 35%, but it is 35 to 40% tax rate is there. So if they are earning any normal income, PGBP is a normal income, salary is a normal income, house property is a normal income. So if PGBP income they are earning, their normal income will be taxable at the normal rates applicable to them, and the normal rates applicable to them will be 40%, 35 to 40%, because they are foreign companies. Foreign institutional investors are foreign companies. For them, their normal income, PGBP income, which they are earning by buying and selling of these shares, is taxable in India. At what rate? 40%, plus surcharge will also be applicable because they will be earning huge profits. Then 4% cess will also be applicable. And they will be investing their money in the shares and securities in foreign exchange. So whenever they will be selling, they will have to repatriate the foreign exchange out of India. So conversion charges will also be there. So approximately 50% of their profits goes in paying what? Taxes, conversion charges, etc. and all. So tell me, if you are a foreign institutional investor who has invested thousands of crores in India, earned hundreds of crores in tax, and hundreds of crores in profits, and out of those hundreds of crores of profits, if half of the profits the government of India only takes, would you ever come and invest in the capital markets in India? Would you ever be interested or inclined in investing in the shares and securities, buying and selling over here? No. And that basically used to happen prior to 2014, when this point was not there. For them, their shares and securities used to be treated as what? Their shares and securities used to be treated as stock in trade. any profit or gain arising on the sale of shares and securities, meaning stock in trade, was taxable for them as their business income at normal rates, which was very high. So they were not getting attracted to Indian capital markets. They were not pumping in their money in the Indian capital markets. Getting my point? So in 2014, BJP government was formed for the first time. Getting my point? BJP government formed for the first time. So before the budget was coming, Mr. Arun Jaitley was appointed as what? Finance Minister. He was the first finance minister under the BJP led government. Yes or no? You must be aware about him. He's no more between us, but he was a superb fellow. Very intelligent guy, very intelligent. So before the budget was supposed to be announced, there were few very important steps which he wanted to take. He wanted to promote the foreign investments in India. Because in order to grow any economy, the foreign investments should flow, should come in that country. And if the foreign investment is not coming, meaning the foreign reserves will not increase. If the foreign reserves are not increasing, foreign exchange reserves are not increasing, then the economy will not grow at a pace at which it should grow. So in order to attract the foreign institutions, investors that come and invest in India in different areas, specifically in capital markets. We have a growing capital markets. Now see, we have a stable government also. Government is formed with complete majority. So whatever decisions we are going to take will not be affected by other parties. The decisions will be taken firmly. Okay. See, that is the reason why a stable government is required. Government with majority in any country is required. Because if we are taking any decision, we don't have to ask other parties that, okay, we are going to take this type of decision. So if the other party people are not, accepting that thing, they will threaten the ruling party that will take our support back and the government will collapse. So that was not the case. BJP had a complete majority at that time, full majority. And don't worry about anything. Whatever policies will be framing will be firmly implemented also. No need to worry because the government is stable for the next 5 years. So they went and asked the foreign institutional investors that bloody why are you not coming to India? Why are you not investing in the capital markets? We have very good companies. Shares of good companies are available. Securities are also available. Debentures, bonds, etc., etc. Come and invest your money in the Indian capital markets. So they said, FIIs told Mr. Jaitley that see, sir, we want to, badly come and invest in your country because it has a superb growth potential. But see, this is the reservation which we have. Whenever we come and invest in your country, our shares and securities are treated as what? They're treated as stock in trade for us. And whenever we sell them, the resulting gain is treated as our PGBP income, which is considered to be a normal income in your country. No special treatment given to us, sir. Because once our income is treated as normal income in your country, it is taxed at normal rates, and in your country, the normal rates for foreign companies is 40% tax. Just you only imagine, sir, if you would have been at our place, would you have ever come and invested? No, na? Then why do you expect us to come and invest in your country? Do something about your taxation system and then expect us to invest in your country. So that thing, pinched Mr. Jaitley, and Mr. Jaitley immediately, he promised there, don't worry, I'll, make some drastic changes in the taxation system so as to attract you guys to come and invest in my country. Because in my country, there is a huge growth potential in the capital markets, and I want all of you to be participating in the new growth story of India. So immediately in the first budget itself, Budget 2014, the budget which was declared after the election, second budget. Mr. Jaitley announced an amendment in this section. He said that from now onwards, to attract the foreign institutional investors to come and invest in India. See, if they are not coming here, if they are not at all coming, and coming also in very, small quantum, the profits which are getting taxed here is a very, 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 very small portion. On that, even if we are charging more tax, we are not able to charge more tax. The tax revenue is very, very, very less. So why not to bring them to India? Make them earn huge profits in huge quantum and charge a very little tax on that. That even a little rate of tax will be too much for us. So this amendment was brought. He said that whatever shares and securities which these FIIs will be having will not be treated as their stock in trade. From this year onwards, it will be treated as their capital asset only. Because if we consider them as stock in trade, the income will be considered as a normal income, normal PGBP income, taxable at normal rates which are very high. So first, exclude their shares and securities as what? Stock in trade. Make that shares and securities as what? Their capital asset. So that the profit and gain arising on sale of these type of securities does not get taxed under the head PGBP, it gets taxed under the head capital gains. And then we will, announce a very, very, very concessional tax rates which will be applicable on this type of capital gains, which will be applicable on this special income which they will be earning now. A very small rate of 10% was announced. Their capital gains arising on sale of these type of shares and securities, even though it should be PGBP, but since we are treating them as what? Capital asset, now it will be treated as a capital gains, because any gain arising on transfer of capital asset is a capital gain, and this type of capital gains earned by this type of FIIs will now be taxable at a very concessional rate of 10%. Immediately a new section came, and in that new section the new tax rate, concessional tax rate, was also offered on the gains arising on these type of capital assets. You won't believe, the moment this amendment came, FIIs were badly waiting for the budget day to come, because Mr. Jaitley had promised that I am going to make such an announcement in the budget. No, you guys will be very happy. So all the FII guys sitting outside, they were watching this budget story and all. You won't believe, the moment this thing came, no, that day the capital markets, it was skyrocketing. The market was too high that day. People had a very, great positive, impact of this particular amendment, because now the people were very, happy. All the market related people, they were very happy that now FIIs will come, they will bring their huge money, they will invest in the shares and securities of Indian companies, because the government has given some relaxations to them. And actually it happened. Since that time till today, if you will see the growth story of the capital markets, no, it is beyond imagination. Since that time only the capital markets have grown. You do some research on Google, you will come to know the capital markets prior to this amendment and capital markets after this amendment. Now the FIIs started investing in huge amounts, and they were bringing their valuable foreign currency to be invested in India. See, the foreign currency reserves also started increasing, and that allowed the economy to grow. We started growing economically strong also, because the foreign currency reserve started growing. Getting my point? And today the situation is, we are the fourth largest economy in the world. We have surpassed Japan also. France or Japan, if I am not wrong. Fourth largest economy. US, China, then I guess one or two more, one country is also there. I don't know exactly, but we are the fourth one. And we have a target to achieve a GDP of $5 trillion within a very short span of time. That is the vision which the government is seeing right now. See, every government has some pros and some cons, okay, no, but in terms of business, in terms of credibility in the international domain, we are something in today's international political system, we have gained that much respect. We are doing very good in the space research and all. We are doing really good in capital markets. In terms of business environment, the business environment is also improving day by day. So these things are happening because of the good initiatives taken by the government. Okay. So any government is there, the responsibility is to do that thing only which this government is doing. So far it is doing good. Okay. Decent stuff. Then this amendment, as per this amendment, now what is the situation? Earlier only one asset was there. Capital asset means asset or property of any kind. And stock in trade was excluded. Stock in trade is not a capital asset because it is also a asset only, no? So in first definition they said, in first exclusion, see, stock in trade is not a capital asset. Why? Because the profit and gain arising on sale of this asset, we want to charge under the head PGBP. And due to this exclusion, the shares and securities held by FIIs used to get excluded. Because the profit and gain was charged under the head PGBP. So what they did? They excluded the stock in trade held by FIIs from the exclusion. Minus became plus. Now, this type of stock in trade will not be treated as stock in trade. This type of stock in trade will be treated as what? Capital asset. Any gain arising therefrom will not be PGBP. It will be capital gain. Because now the asset is also a capital asset. Got it, sir? Should I move ahead? Perfect, sir. Any other stock in trade? Any other stock in trade? What will you do with that? Any other stock in trade? Not a capital asset. Excluded. See. Why excluded, sir? Because profit or gain arising on sale of stock in trade, we are charging under the head PGBP. If we consider this asset also as a capital asset, then the gain will be taxed once under the head PGBP. Next time it will be again taxed under the head capital gains. Why? Because it is a capital asset also. So the gain should not be taxed at two places. It should be taxed at in only one place, and that is PGBP. And if the gain is already getting taxed, profit is already getting taxed under the head PGBP on buying and selling of what? Stock in trade, not to be taxed under the head capital gains again. Hence, it is important to exclude the stock in trade from the definition of what? Capital asset. Because every asset, every property is a capital asset. So by mistake, the stock in trade is also covered. So let's do one thing, exclude the stock in trade. But while excluding the stock in trade, don't exclude the stock in trade of FII, meaning the shares and securities held by FIIs. Don't exclude from the definition of capital asset. Why? Because it is now specifically included in the definition of capital asset as per point number B. Yes or no? Now can you see point number C? ULIPs, whose maturity proceeds are not exempt under section 1010D. And see what I have written besides this. This is a third type of asset which is considered as capital asset. You just have to remember this name, that ULIPs means unit linked insurance policies. Unit linked insurance policies. They are special type of insurance policies which has a benefit of units in it. Or you can say special type of units having a benefit of life insurance also. Either you go and invest in units, you will earn capital gains. or you go and take your life insurance policy, life will be insured and you will get the maturity proceeds also. Yes or no? But this is a combination of these two things. This will be your life insurance policy only. Whatever premium you will pay on this policy, whatever premium which you will pay on this policy, against that premium, you are going to get your life insurance. Getting my point? Your life will be insured. But that is not the only benefit which you are going to get from the premium on this policy. The amount of premium which you will pay will be converted into units. Against that, you will be issued some units. For example, if there is one mutual fund, there is UTI, there is LIC, they have these kind of insurance plans where they take money from you as premium. But that is not premium. Don't worry. The money which you are going to pay, that is going to cover your life insurance. Your life insurance is an additional benefit, but ultimately you are paying for the units under this plan. So the money which you are going to pay will be against that. Units will be issued. Units is as good as shares. Okay, no? Units will be issued. Again you pay the premium, units will be issued. Again you pay the premium, units will be issued. So you are accumulating units. Premium paying, that amount is allowing you to accumulate the units. Now what will happen? Slowly, for some time, the units will be getting accumulated. But at that time, when this policy will mature, at that time it will be seen that how many units you have accumulated so far now. Now the value of that units at that time, after 5 years, 10 years, will be very much high. And at that value, the units will be matured. Getting my point? Just imagine you are not taking any insurance policy. Yes or no? Your ultimate intention is to invest in units, but an additional benefit happening, that life insurance is also happening. Additionally, your life is also insured. Hence, these type of units where this life insurance benefit also happen on you investing in such units, life insurance benefit also happen that your life is also getting insured. Okay. These type of units, therefore, these type of policies, therefore, are known as unit linked insurance policies. Now, after few years, whenever the policy will mature, at the time of maturity, these units will be taken from you. The value of this unit at the time of maturity, that will be given to you as your maturity proceeds. And you know, if some units are acquired, if you are, investing in plain units, not the ULIPs, just units of some mutual fund, just units of some insurance company, units of UTI. If you are investing your money in units only, which don't have insurance plan attached to it, normal type of units, when you invest, keep on investing, keep on accumulating units. And when these units are sold at a higher price, gain will arise. That gain is taxable under the head capital gains. If you just invest in units. But if you take insurance policy, plain insurance policy, yes or no? Without any units linked to it. Plain insurance policy, you invest your money, meaning you pay the premium, your life will be insured. And after some time, when the policy matures, at the time of maturity of the policy, you will get the maturity proceeds. The premiums which you have paid for these many years, plus some extra amount you will get in the form of bonus. So the sum assured is 10 lakhs. So they are going to take approximately an amount which is near to 10 lakhs as premium over a period of some time. Yes or no? See, if the policy is taken for 10 years. So for 10 years, every year they are going to take some amount of premium. Policy is for 10 lakh rupees. minimum sum assured is 10 lakhs, meaning that from this policy, minimum benefit which will happen will be 10 lakh only. That is sum assured. If you die, your family members will at least get 10 lakhs. Or if nothing happens to you, the policy will mature, at least you are going to get 10 lakhs. So to give you that 10 lakh rupees of benefit, the insurance company is going to take money from you, premium from you. So the total premium taken during the 10 years of the policy time, for example 10 years, for 10 years you are taking the policy, during those 10 years time the insurance company will take nearly 7-8 lakhs as what? As your premium. And then at least 10 lakhs will come along with some bonus etc. on maturity, or at least 10 lakhs will come along with some bonus, if any, to the legal heirs, nominees, if the insured person dies. Now whenever the insurance policy is matured, that time the maturity proceeds comes, no, it gets exempted under section 1010D based on certain conditions that we are going to see in IFOS. So when you take your life insurance and any maturity proceeds coming from that life insurance policy, maturity proceeds, usually these type of maturity proceeds based on certain conditions is fully exempt under section 1010D. Now you know that what happens when units are acquired. What happens when you invest in life insurance policy? What happens when you acquire just units, normal units? You invest, you will get units. Whenever at a higher price you will sell the units, whatever gain will arise will be taxable under capital gains. What happens when you invest in life insurance policy, normal plain life insurance policy? What happens? You keep on paying the premium equal to the value, nearby the value of your sum assured. So at the time of maturity, that entire premium comes back with a small extra amount in terms of what? Bonus over and above the sum assured. That is fully exempt, 1010D fully exempt. Now what if these two benefits are combined? What if these two things are combined into one? Then this one thing is what? ULIP, unit linked insurance policy. Now keep on paying the premium, no? Your life will be insured. So life insurance you are taking by paying the premium, but now the premium is not paid for normal life insurance policy, it is paid for this life insurance policy, ULIP. Your life is insured. If anything happens to you, minimum this much amount will be given to your family, including bonus if any. Getting my point? But wait, if nothing happens to you, on maturity, you are going to get some money. And how much of that money you are going to get at the time of maturity, you know? See, every year when you will give the premium to us, no, against that premium, we are going to issue some units to you. And every year, the value of these units will grow. And whatever units which you will accumulate over the period of this policy, no, those units will be valued at the time of maturity of your policy. And you won't believe the value of these units will be way higher than your maturity proceeds or sum assured. It will be very, very, very high as compared to your sum assured. So what benefit will happen, you know? You have invested in units, only 10 lakh rupees. During the tenure of 10 years, you have invested only 10 lakh or 9 lakh something, yes or no? And that 9 lakh will grow to 15 lakh, 16 lakh, 18 lakh after 10 years. And that 18 lakhs is what? 9 lakh invested in the form of premium will allow you to take units. These units will be valued at the time of maturity, and the value of these units will grow, which will be more than the amount you have invested for sure, 100%. And it will be more by how much amount? It can be till any amount, because there is no restriction on the amount, higher amount. The value of the units will grow, keep on growing, keep on growing, keep on growing. Whatever will be the value of each unit after 10 years, after the policy matures, multiplied by number of units which you have accumulated so far. That much amount will give you as what? Maturity proceeds. Understanding? Now what will happen, at that time, at that particular time, whatever maturity proceeds will come to you, call that amount as your maturity proceeds of life insurance policy and claim it exempt under section 1010D. Actually speaking, this is not your life insurance policy maturity proceeds. This was the amount which you wanted to invest in units and you wanted to grow this amount, and it also grows, but you are claiming it exempt under section 1010D as your life insurance policy maturity proceeds. Now you won't believe, everyone, instead of investing in normal life insurance policy or normal units, they started preferring these kind of ULIPs because they had an advantage of investment in ULIPs growth also, and another advantage, that growth was not taxed in their hands in the form of capital gains. Why? Because they were saying that this is not the amount coming on sale of units, normal units. This is the amount coming from my life insurance policy as maturity proceeds, which I will exempt. Getting my point? Benefit of a unit and the treatment which you used to give when you used to get the amount was of a life insurance policy. Maturity proceeds coming at the time of maturity of life insurance policy is fully exempt under section 1010D, and actually you used to get the exemption also for this. So these type of units allowed the taxpayers to do some tax planning, avoid some taxes. That what would have happened if you would have invested the same amount in units and units were sold by you, or they were against that units you were getting money at the time of maturity. This much amount you would have got by selling the units. This would have definitely be treated as your capital gains. You would have definitely paid this amount, paid tax on this gain happening on units. The same gain happening on these type of units also. But what you are telling? That it is my life insurance policy, maturity proceeds, hence exempt. So there was a loophole which the taxpayers was exploiting. Getting my point? So to plug that loophole, 2-3 years back, there was an amendment which came in section 1010D, where they had put some restrictions that beyond this any amount is invested in ULIPs, and on those type of units, if the maturity proceeds come, that maturity proceeds will not be treated as maturity proceeds of life insurance policy. That will not be exempt under section 1010D. Now that maturity proceeds will be taxable. And any gain which is there in that maturity proceeds is a form of capital gain. We would like to charge that amount under the head capital gains. And in order to do that, we will have to first make these type of policies a capital asset. Only then the gain hidden in that maturity proceeds, which is of capital gain nature, only then it can be charged under the head capital gains. Getting my point? Hence, it was very important for these units also, ULIPs also, to be treated as what? Capital asset. See, this much basic knowledge you should have. That's it. Basic, no. This is the entire knowledge which I have given you. But remember, this type of ULIPs and their tax treatments are not there in your CA intermediate syllabus. Hence, the effect of this under section 1010D, I am not going to explain. Why? Because that is not in your syllabus. And in the capital gains also, there is one specific section. Can you see this? This is a specific charge. Under this section, the gain arising from such ULIPs is chargeable under capital gains. This section tells you that any gain arising from those ULIPs, which are now your capital assets, yes or no? Any gains arising on those ULIPs, will now be treated as your capital gain income as per this charging section, but which is not in your syllabus. So the charging section which is not there in your syllabus, charging the tax on a specific type of capital asset, that capital asset also is just one read. You just have to remember that this type of asset is also a capital asset, that's it. Any gain arising on this type of asset is chargeable. Because it is not exempt under 1010D, then it is chargeable. Where it will be chargeable, how the capital gain will be calculated, it is given in 45(1)(b), which is not there in your syllabus. When the amount from these ULIPs will not be treated as exempt, when the amount will be treated as exempt, that is given when we are going to do 1010D. In 1010D it is given that under what circumstances the amount coming from these ULIPs will not be exempted under section 1010D. Those circumstances we are not going to do, because this entire concept of ULIPs is kept outside the syllabus of CA Intermediate. The year in which this came as an amendment, no, first year, it was kept in the syllabus of CA Intermediate also. That year I taught also, 2-3 years back. But now the institute has taken out from the syllabus only. Why? You don't understand bloody the basic provisions of capital gain. These are advanced provisions of capital gain. How would you understand these things? That too also in CA Intermediate level. Many students were finding it very difficult. Actually it was not. Actually it was very easy. And right now also I have told you, you must be excited to learn this thing. Yes or no? But see, if this is not in our syllabus, then why to waste time over here? Still, whatever time I have given is not a waste of time. It is just a general knowledge which I gave you, which you should be aware that okay, something like this will come. No, it will be definitely written there that this thing is not in your syllabus. You can check in your ICI study mat also. Got it, sir? So 3 types of asset, the names you have to remember. Asset or property of any kind. Tangible, intangible, movable, immovable, fixed, circulating, whether used for business or not. All these assets are your capital asset. Any property, any asset is your capital asset. Number 2, the shares and securities held by FIIs as per SEBI regulations. What did I say? Shares and securities held by FIIs as per SEBI regulations, even those shares and securities, for them it is stock in trade. Earlier also, we also considered them as stock in trade. But these shares and securities in which they have invested, FIIs have invested in India, shares and securities of FIIs of Indian companies, yes or no, which they have invested by following the SEBI regulations, will also be treated as their capital asset and not their stock in trade. Number 3, unit linked insurance plans, ULIPs, whose maturity proceeds are not exempt under section 1010D, meaning their maturity proceeds is taxable. Then their maturity proceeds will be taxed under which head? It will be taxed under the head capital gains. In that maturity proceeds, whatever capital gain is hidden, that is to be calculated and to be taxed under the head capital gains. But in order to do that, the ULIPs are to be first treated as your capital asset. Which ULIPs? All ULIPs? No, only those ULIPs whose maturity proceed is not exempt under 1010D. Because there are certain ULIPs whose maturity proceeds gets exempted. Those type of ULIPs are not capital asset. Getting my point? Because their maturity proceeds is exempt. But which type of ULIPs are covered here, treated here as capital asset? Only those ULIPs whose maturity proceed is not exempt under section 1010D, whose maturity proceeds are taxable, will be covered here as a capital asset. Got it, sir? Now, these are your capital asset. The term capital asset means this. Got it, sir? This. Now, what is not included in the definition of capital asset? Number 1, stock in trade is not your capital asset. Because since we have covered all the assets now, so now in the assets, which I have covered in the definition of capital asset. Many assets are there. Many assets are there. So I am finding some asset to go out from the definition of capital asset. I don't want to consider you as a capital asset. So first asset the government saw. Okay, stock in trade. Shh. Are you a asset? Yes. So why have you come to this capital asset? You only said no. That all the assets, all the properties are capital asset. So I am also an asset in the business. So I came here in the definition of capital asset. No, you don't belong to this category. Go out of capital asset definition. We will not consider you as a capital asset. Stock in trade is asking why? Because any profit or gain arising on your transfer, no, is to be taxable under the head PGBP. And if you are charging that under the head PGBP, why are you getting covered over here? Because if you will get covered here, what will happen? That profit and gain which is already getting charged under the head PGBP will be second time charged under the head capital gains. We don't want to charge it for the second time under the head capital gains. So move out. You are not a capital asset. So, see what was happening? They were moving out the stock in trade. No, they were moving out the stock in trade. So the shares of securities of the FIIs were also going out. If the stock in trade is going out of the definition of capital asset, so all the stock in trade will go out. Hello, stock in trade, please vacate the premises, go out of capital asset definition, go out of capital asset definition. Stock in trade is going out, moving out, moving out. Behind this stock in trade, the shares on securities of FIIs were also going out. Government said, hello, stock in trade, shares and securities of FII. You are not excluded. You stay here only. We have specifically made you capital asset. Okay, no, you stay here only. So remove all the stock in trade from the definition of capital asset, but don't remove the shares and securities held by FIIs. Will you remember this? Second type of asset which is excluded is movable personal effects. Movable personal effects. Are they saying personal effects or movable personal effects? Movable personal effects. What is the meaning of movable personal effects? See, here everyone. Utensils at my home. Movable personal effect. Furniture at my home. Movable personal effect. Fridge, TV, washing machine, AC, geyser, mixer grinder, microwave oven, my household furniture, television, music system, my personal motorcycle, my personal motor car, all those assets, even my clothes, my accessories, my watch, my mobile phones, all those assets which are used for personal purpose by the assessee or any of his family members and which are movable in nature are known as movable personal effects. Since we have covered all the assets, all the properties of any kind. So now in the capital gains definition, all the assets are covered. So these were also covered. But we did not have any intention to cover them. But at the same time, we did not want to miss any asset also. So what we did, we covered everything in the definition of capital asset. So in that everything, movable personal effects also came. So now what we are doing, we are telling, hello movable personal effects, what are you doing here? You only said no, all the assets, all the properties are capital asset only. So we are personal effects, meaning we are the personal assets of the assessee. We are also the assets. So what? We don't want you to be here. Come on, move out. You are not a capital asset. Go out. Why the government is throwing them out from the definition of capital asset, Because movable personal effects has a characteristic. What characteristic, Over a period of time, over a period of their use, their value is not going to increase. Their value is going to come down. Just talk about an Apple iPhone, okay? No, that iPhone, when you go in the store and buy that iPhone, you are buying that iPhone for 1 lakh rupees. Example, if you are buying that iPhone for 1 lakh rupees, so today the value of that iPhone is 1 lakh rupees. The moment you open the box, yes, the moment you open the box, even if you are not used for a single second, box is opened, the value starts deteriorating. Over a period of use, it will come down more. And after some time of use, no, its value will not be more than 1 lakh. Its value will be very, very, very less as compared to 1 lakh. Now, after some years, if you are going to sell that iPhone, you don't have to, you will have to sell it either on OLX or to someone you know, or to someone who is a second hand mobile dealer. And they are not going to take this iPhone for 2 lakh rupees or 3 lakh rupees or 1 lakh 50,000 rupees from you. They are always going to give you something which is lower than this actual cost also. So will there be any profit arising on selling these type of assets? Almost every case there will be a loss. Majority of the cases, 99% cases, there will be a loss. Okay. And if these assets are also treated as what? Capital asset, what will happen? The assessee will calculate loss because the cost was higher, selling price is lower, lower selling price minus the higher cost, resulting income will not be positive, it will be negative, loss will be calculated. And the year in which the assessee is having huge capital gains, in that year, don't you think that the assessee will start selling these type of movable personal effects and start accumulating losses so that those losses can be set off against taxable capital gains? And knowing that these assets are not going to give you profit, if you are still considering this asset as your capital asset, hello, then we are only fool. So why to consider any asset which is not going to give you a profit in future? Why to consider that as your capital asset? Exclude. The clothes which I am wearing right now, see this shirt, no, this shirt. I bought this shirt for 1000 rupees, okay. 1000 rupees I bought and I have at least wore it 20 to 30 times I wore it. Now when I will go in the market and sell it, no, nobody is going to buy it from me, first of all. And even if somebody buys it from me, is anyone going to pay me more than 1000 for this? No, nobody will give me more than the cost. Bloody, I cannot recover the cost also by selling it. The value has come down so much that now either I have to throw or I have to use it as cleaning cloth. And if somebody purchases also from me, he is not going to give me 1000 rupees for this now. What he will give me? 50 rupees, 100 rupees, 200 rupees. And tell me where these things are sold. Nowhere. So isn't it my personal effect? Yes. Isn't it my personal effect? Yes. And it is movable also. Will not be treated as a capital asset because their value comes down. You just wait for some time, macha. Don't be too much, active. No need to be. All the doubts will get resolved. Slowly, gradually, everything will come. Kaushik, be a little bit, this patient. You'll be definitely getting the answers of all your questions, okay? But see, sometimes few questions which are coming, no, they are premature questions. The discussion is yet to happen. And you are asking. So if you are getting any doubts, no, write down this behind your notebook. Okay. Let the lecture pass on. Few of the doubts will be resolved automatically. You will put a tick. And if some doubt still remains, no, ask me in the break time. No, I am there to solve. Okay. But if I'll keep on answering the doubts like this, I'll not be able to continue. The link will be broken. Getting my point? Okay. So, okay, what I was saying that movable personal effects is not a capital asset, but that has to be a personal effect first, and that has to be movable also. What if it is a personal effect but not not a movable asset? It is an immobile asset. Possible or not? Tell me. Best example is the house where I live. This is my house where I am living. Is it my personal effect? Yes, this is used by me for my and my family's residential use. It is my personal, this is an asset which I use for my personal purpose. Isn't a personal effect? Yes, it is a personal effect, but it is not movable. What we are excluding? We are excluding personal effects which are of movable nature. Is it a personal effect? Yes. Is it movable? No. Then don't exclude. In the definition of capital asset, guys, in the definition of capital assets, all properties are included. So now, whom are you telling to go out? That you are not covered in capital asset. You are telling to go out that movable personal effects, please vacate the premises, please go out of the definition of capital asset. So movable personal effects are going. Personal effects are moving out. Because they are movable. So they can move out. What about those personal effects which are not movable? Once they are covered there, no, they will not move. Why? Because they are immovable. Cover your house property, residential house property. Is it movable? No. So it will stay there only. We are moving the movable personal effects out. Go out. Now when you were moving the movable personal effects out, no, there was Mr. P.J. Das. Who? P.J. Das. P for paintings, J for jewelry, D for drawings, A for artwork, again A for archaeological collections, S for sculptures, and last S stands for shares. P. J. Das. Getting my point, everyone? P for paintings, J for jewelry, D for drawings, A for artwork, A for archaeological collections, S for sculptures, again S, that stands for shares. So when you were moving out the movable personal effects, no, so Mr. P.J. Das was also following. Mr. P.J. Das was also going out. You stopped Mr. P.J. Das. You said, P.J. Das, where are you going? You only said, no, movable personal effects go out. So we are also movable and we are also used by the assessee and his family members for personal purposes. So we are also movable personal effects. So you are throwing out all the movable personal effects. So along with movable personal effects, we are also movable personal effects. So we are also feeling bad. We are also feeling humiliated. We are also going out. No. You all don't go out. Because in our eyes, in the eyes of the government, all movable personal assets are movable personal effects except PJ Das. You all are not movable personal effects. Please don't feel bad. Please stay here only. Please don't come out of the definition of capital asset. We don't want to exclude you. We want to exclude any movable personal effects other than you. See, capital asset defined. Please pay attention. See here, everyone. Capital asset defined. All the assets covered. Now we are taking out movable personal effects. We are taking out movable personal effects. But from movable personal effects, we are taking out PJ Das. Minus will become plus. So they are still your capital assets. Movable personal effects does not include PJ Das. PJ Das will still remain capital asset only. Why? Why all the movable personal effects were excluded because their value over a period of time will decline. Yes. But think about PJ Das. Paintings, jewelry, drawings, artwork, archaeological collections, sculpture, shares. The more older they will become, the more time you will hold them. Over a period of time, their value will decline or it will go up. It will go up, yes. So there are bright chances. Majority of the cases, when they will be sold, it will be a profit and the government wants to charge tax on that profit. It is possible only if they are kept as your capital asset, hence not excluded. Getting my point? Easy? Sure? So this was your second exception. First one was stock in trade. Exclude stock in trade, but don't exclude stock in trade of FIIs. Shares and securities held by FIIs will not be excluded. Other than that, all the stock in trade will be excluded. Next one, exclude movable personal effects. Exclude movable personal effect, but don't exclude PJ Das. That is still your capital asset. Other than that, exclude all the movable personal effects. Any personal effect which is not movable, which is immobile, that also will not be excluded. These are capital assets. Exclude only movable personal effects. Yes or no? Now, third exception is rural agricultural land. If you remember something which we discussed yesterday, there are two types of lands. One is rural, one is urban. That circle I made, color, pink color inside, orange color outside. So if any land falls within that area of the jurisdiction where the population is more than 10,000 and within the 2 kilometers, 6 kilometers, 8 kilometer radius from the local limits of that municipality or local authority, whatever land falls within that radius is urban. Any land falling outside this will be rural, will not be urban. Now you have a rural agricultural land. All the assets you covered in the definition of capital asset. So even your rural agricultural land was covered. So you said, hello, rural agricultural land, what are you doing here? You only said, no, all the assets are capital assets. Tangible, intangible, movable, immovable, fixed, circulating, whether used for business or not. All the assets, capital asset. You only said no. So we came here in the definition of capital asset. Ayo, we don't want to consider you as a capital asset. Go out, come on, leave. You are not a capital asset. Then the rural agricultural land asked that why are you throwing me out? Why are you not considering me as a capital asset? You said, because any income arising on your transfer is treated as an agricultural income. And if we consider you as a capital asset, then unnecessarily that income will be taxed under the capital gains, which is treated as agricultural income and which is exempt. So if the government wants to give you the exemption for some income as what? Agricultural income, that income will be automatically taxed here if rural agricultural land will be treated as capital asset here. Getting my point? Hence, to keep that exemption alive, to keep that exemption intact, it is important to remove the rural agricultural land outside the purview of capital asset. Because if it is kept here, the income which was agricultural income, which was supposed to be exempted, will now be taxed under the head capital gains, which should not happen. And to avoid that, what we are supposed to do? Remove the rural agricultural land from the definition of capital asset. Remove it. Will you remember this much? Only rural agricultural land. Only rural agricultural land is removed. Meaning rural non-agricultural land, will it be removed? No, stay there only. You are not supposed to move from here. Urban agricultural land or non-agricultural land, you also don't move, stay there only. So rural non-agricultural land, urban agricultural land, urban, non-agricultural land, they are not to be excluded. Only rural agricultural land to be excluded. Yes or no? Meaning every other land, every other building, land, building, meaning every immovable property will be your capital asset only. Only one immovable property cannot be treated as your capital asset, and that one immovable property is rural agricultural land. Other than rural agricultural land, all the immovable properties, any type of land, any type of building, residential building, commercial building, rural non-agricultural land, urban agricultural land, urban non-agricultural, any type of land, any type of building other than rural agricultural land will always be treated as your capital asset only. That is not to be excluded. So whenever they will be transferred, definitely the capital gain will arise and it will be taxable also. Will you remember this, friends? Sure, sir? Okay. First one, what was excluded? Come on, tell me. Stock in trade. But don't exclude shares and securities of FIA. Second one, what was excluded? Movable personal effects. But don't exclude PJ Das. Yes or no? Movable personal effects means those assets which are of movable nature and which are used by the assessee or his family members for personal purpose. Meaning a car used by the assessee for personal purpose. Is it a movable personal effect? Yes, exclude it. Not a capital asset. No profit gain will be chargeable under the head capital gains. Even if you sell the car for some higher amount also, no. Even if you get profit, no. That is by chance. In one or two transaction exceptional cases it can happen. But just to charge that amount under the Income Tax Act, we cannot cover the asset as a capital asset. No, because in all the other 99 cases, there will be a loss only. So we'll have to allow that loss also as capital asset if you want to charge tax on this one transaction. Yes or no? That will not be advisable to do. See, by chance one or two transaction profits are there, we'll have to leave that profit in order to save ourselves from allowing the losses as set off. It is better not to consider this asset as what? Capital asset only. Yes or no? So my car is a capital asset or not a capital asset? You will tell me. Come on, my car is a capital asset or not a capital asset? Not a capital asset. My wristwatch is not a capital asset. Hello? My specs, not a capital asset. My clothes, not a capital asset. Utensils at my home, not a capital asset. Hello, sir. Mixer, grinder, air conditioner, washing machine, fridge, TV, furniture, nothing is capital. My footwear, not a capital asset. Because all these are personal effects. Wait. If I am having iPad, is it my capital asset or movable personal effect? Tell me, is it my capital asset or not a capital asset? Not a capital asset. Then my dear friends, you are wrong. This iPad I am not using for my personal purpose. It is used in my profession. It is a movable asset but not personal effect. Because it is not used for my personal purpose. What I am doing with this iPad? I am using it in my business. Any asset. What did I say? Any asset, any type, tangible, intangible, movable, immovable, fixed, circulating, whether used for my business or not, is my capital asset. So even the assets which are used in my business are capital asset only. Car. Now if you will say no, it is a movable personal effect, you are gone. You will have to first see that whether the car was used for personal purpose, then it is a movable personal effect, not a capital asset. But if that car was used for business, hello, then it is not a personal effect. Then it is a business asset. It will be treated as a capital asset. And that is the reason why these cars, computers, etc. goes in the block under the PGBP head, and resulting gain or loss We consider that under capital gains, section 5050. Do you remember? Why capital gains, sir? Because that gain is from a capital asset only, which was used for the purpose of business or profession. They are not movable personal effects. They are movable business assets. Yes, hence they are capital assets. This is one catch. Will you remember this? Sure. Now, second catch. P.J. Das is a capital asset or not a capital asset? Is a capital asset. Yes or no? P for paintings. D for drawings. What is the difference between paintings and drawings? Sir, when there is color, no, it is painting. When there is no color, may be color or may not be color, may be a sketch, it is a drawing. Don't give me these bullshit answers, okay? Because even I don't know the difference between both of them. Because I never wanted to know the difference also. What difference will it make if I know the difference? It will not make any difference. Why, sir? Because if you call a drawing a painting, still it is your capital asset. If you call a painting a drawing, still it is your capital asset. It will not make any difference. Difference will be made to the person who has drawn it. He will feel bad. That why are you calling my drawing as a painting? It is a drawing, no. For you it is drawing. Consider it as a drawing. For a person studying taxation, and that too also the definition of capital asset, he is not bothered about the differentiation between what? Differentiation between paintings and drawings. Yes or no, sir? Even paintings are capital asset. Drawings are also capital asset. Sir, by mistake, you know what happened today? In my examination, the item given was painting, but wrongly I considered it as a drawing. It will not affect your tax treatment. Tax treatment remains same, even if you don't know the difference. So don't, waste your time in such kind of things. The drawings and paintings both are same. No. Sorry, both are different. No. Then if they are not different, then if they are same, then not different. No. If they are not different, same. No. Don't do all these things. What is the meaning? What is called as drawing? What is called as painting? No need to know the difference. Painting is also a capital asset. Drawing is also a capital asset. And by mistakenly, if you exchange the meaning also, then also there will be no tax treatment or difference. The treatment remains same. Okay. Now J for jewelry. J for jewelry. Do you remember J for jewelry? What is the meaning of J for jewelry? Come on, tell me. Any one of you. What is the meaning of jewelry? Because the things which you are having in your mind, no, are not jewelry, they are ornaments. You must be thinking about gold chain. You must be thinking about ring. Okay. You must be thinking about bangles. All these things are ornaments. So ornaments which you are thinking that they are jewelry, you are correct. You are correct. But not fully correct. Because ornaments only is not jewelry. The definition, the meaning of the jewelry is very wide. It covers many other things other than ornaments also. So I will have to tell you. Okay, wait. What is the meaning of jewelry, no? Come, let's see. Jewelry. First question. Jewelry is a capital asset or not a capital asset? Capital asset, no? Sure. I will change your mind after some time. But right now it is a capital asset, okay? Jewelry is a capital. What is capital? What is jewelry then? Jewelry means any precious or semi precious metal or their alloys. Alloys means what? Have you studied chemistry in your childhood? One metal is metal. Second metal is also metal, but when you combine these two metals or more metals together, then a new type of metal is made, which is a combination of multiple metals. Yes or no? That is known as alloys. Okay. So if you have any metal with you, which is precious or semi precious, or even a mixture of such kind of metals, alloy, then it is jewelry. Wait. Either you can hold them as it is, held as it is in the form of what? Metal only. Like coins, biscuits, bars, bricks. Silver bricks are also made. Gold bars are also made. Okay. Gold coins, silver coins are also made. So whatever coins are there, bricks are there, bars are there, then biscuits are there. These are not the biscuit which you dip in the tea and eat. Gold biscuits. Okay. Now these we call as etc. We call these items as bullions. Bullion. Will it be treated as jewelry? Yes, I have put a tick mark. Bullion is a jewelry, meaning any metal or a semi-precious metal or alloy of such metals, you hold them as it is. As it is means in the form of bullion, then it is jewelry. So if you are buying and selling these items, no, hello, it will result into what? Capital gains, because it is a capital asset. Jewelry is a capital asset, so it is a jewelry. Getting my point? Now, can you have precious or semi-precious metals or their alloys uh, converted into some article known as ornaments, wearing apparels? See, many people are so mad about gold, no? They have made their clothes also with gold thread. Many females, they wear saris having gold thread embroidery. Wow! Thread made up of gold, and with that thread the wearing apparels are made. Wearing apparels are made. Getting my point? Ornaments are made. Even utensils are also made with these metals. Have you seen silver utensils, gold utensils? Small dishes, small, those spoons, etc. Small utensils. These utensils are made with precious or semi-precious metals like silver, like gold, etc. At my home, no. See, every Diwali in our Gujarati and Marwadi families, what we do, we we do Lakshmi Pujan at home. Okay. So at the time of Lakshmi Pujan, we offer bhog, we offer prasadam to Mahalakshmi. And at the time of offering that prasadam, what we do, we offer that in a very good, very, what do you call it? sacred utensils, not the utensils which we usually use at home for our food consumption and all. So their utensils will be sacred. It should not be used on a regular basis at home, and they should be little bit, attractive also, costly also, because we are offering something to eat to the goddess Lakshmi, okay, on Lakshmi Pujan. So these utensils are made with gold, silver, etc. They are kept in my cupboard, in my mom's cupboard. Whenever the Lakshmi Pujan will happen at the midnight of Diwali, my mother takes them out of the cupboard, of the locker, and it will be properly cleaned. The food, the prasadam will be served in that, okay, and it will be offered to Mahalakshmi. And then once this is offered, just like other utensils, it will not be thrown in the sink. That okay, that maid will come, she will wash and she will go. No, maid will come, she will wash in such a way that it will vanish. Getting my point? So my mother only takes care of all these things. She never leaves these things unattended. Even if it is in the puja room, no. Even if it is lying there during the entire period, my mother's eye will be on that, because that is something which is very costly. It is valuable thing. My mother will not have that much importance or attention to normal steel glasses or normal steel plates, spoons, etc. at my home. She doesn't care about those things. It will be thrown like this in the sink. Maid will come, wash it and go. Even if maid goes away with 2 or 3 spoons, she will not be bothered, because that is not costly. But the utensils made up of gold, silver, etc., which are not regularly used, which are very heavy, they are not in regular use. They are kept as a valuable item. Just like I store my ornaments, just like I store my jewelry, I store them in cupboard. So they are not my normal utensils, they are not my movable personal effects, they are my jewelry only. I have some wearing clothes, apparels. In that I have used this material. In that I have used this metal, etc. So these wearing apparels are no more my normal clothes. They become valuable items for me. I will not throw it inside the washing machine to be washed by my maid. Next day this will not appear. This will vanish. I will take care of this thing. Very diligently I will keep it. I will not press it also. So this is valuable thing. There is some, table, or there is some pen. That pen, I have made the entire outer covering with gold, with my name embedded on that, CA Umang Thakkar. That pen for me will now not be a normal thing, personal belonging. No, now it will be my jewelry, something valuable to me. I will take care of this thing more than my life. Getting my point? So these metals can be held as it is, or they can be converted into many other things like ornaments, wearing apparels, and even they can be embedded on some furniture, etc. also. Many people have chair, etc. at their homes made up of gold, just like Sinhasana, just like the throne of a king. They will be sitting in that chair, and the handles of the chair, the back side of the chair will be made with a heavy metal like gold, silver, etc. Now that is not a normal furniture. That is something which is valuable, made up of this material, made of this metal, as good as your jewelry. Getting my point? Because now the value is more. Now it has become valuable. Now it does not remain your movable personal effect. Now you will not be using it on a regular basis, just like your movable personal effects. Getting my point? So any precious or semi-precious metals or their alloys, either held as it is or converted into wearing apparel, ornaments, utensils, furniture, etc. My dear friends, these are also treated as your jewelry because they are not regularly used for personal purposes. Yes or no? They have a very limited use. Okay? Now pay attention up, pay attention. Second part. Second part is copy, paste. Now stones will come. Stones which are there on the road, no? They are very precious or semi-precious, no? Which type of stones I am talking about? Yes, diamonds, emeralds, pearl, sapphire, blue sapphire, ruby, yellow sapphire. See, I'll tell you. Okay, see, you can see me wearing two finger rings. Can you see these two finger rings? This first one, no, is yellow sapphire. This is for Brihaspati. Some Jyotish importance, I don't know much. My father has given me, and that is the reason why I am wearing. This second one is, no, this is a blue sapphire, known as Neelam. First one is yellow sapphire, known as Pukhraj. This one stone, no, this costs around 40,000 rupees. Only the stone. The first one, no, yellow sapphire, this cost 70,000. I have that certificates given by the shop from where I have bought it. Certificate of authenticity, that it is a precious as well as semi-precious stone. Okay, there are different qualities also. If you want to buy blue sapphire, no, it can go till 2 lakhs, 5 lakhs, 10 lakh also. Blue sapphire, yellow sapphire also like that. Very costly things. But I am not wearing that much costly because it is not required, and I am not that much fan. Sometimes you will not see me wearing these things. These will not be in my hands also sometimes. But my father insists me to wear all these things. So I have, as per the request of my father, and even I like, having some or the other thing in my hands, I am wearing them. So if these things are there, these are what? Stones only. But are these stones normal stones on the road, on the footpath? So they become precious. I am wearing them with me. Hello, as a part of my ornament. It has their importance. They are very attractive. So if I am having these stones, I can have these stones as it is also, and I can convert these stones. I can use these stones in wearing apparels. I can use them in ornaments. I can use them in utensils, furniture, etc. So these stones also, whether kept as it is or converted into these items, will also be treated as my jewelry only. Getting my point? So what I'll do? I will connect a line here. If they are also held as it is, but they will not be treated as bullion, but they will be treated as stones, normal stones. Okay. Now they can be converted also into wearing apparels, ornaments, blah blah blah. So whatever things which are containing these stones, those things will no more be movable personal effects. Those things automatically becomes what? Jewelry only. Getting my point? See, this is the definition of jewelry. Okay. Now wait. I have not yet said that they are capital assets. I have just made sure that what is jewelry, you understand that. Can it be treated as a capital asset? If it is a jewelry, it can be treated as a capital asset. Yes or no? Jewelry is a capital asset, but not every time. Why? I am running a jewelry shop. In my shop, my jewelry is not my capital asset. In my shop, my jewelry is my stock in trade. Buying and selling will result into PGBP income. So for me, my stock in trade, jewelry, will not be a capital asset. So jewelry can be any of these items, will be treated as jewelry. Okay. For a jeweler, for a jewelry shop owner, it is stock in trade, not a capital asset. Yes or no? And for others, it is a capital asset. Done. So we are jewelry shop owners. Do you think I have a jewelry shop? I have a jewelry shop. Do you think? No. Though my mother has too many jewelries, okay, but I am not a jewelry shop owner. I am fond of jewelry, just like other people are. Fond of wearing jewelry, fond of wearing ornaments. But I am not a jewelry shop owner. So for me, whatever jewelry I have, okay, no, that jewelry which I am having for me is not a stock in trade of my business. It is my investment. I have invested my money over there, knowing that the money which I have invested right now, no, sooner or later, with the passage of time, the money will grow. You know, this ring, I got it made 2.5 years back. Okay, it has a gold of 10 grams, minimum approximately 10 grams of gold worth 70,000 at that time. And this 70,000, 70 plus 70, 140, approximately 1.5 lakhs. Only this single ring, okay, it costed me at that time. Now, if I'll go and sell it, no, it will have more value because the prices of gold has increased. The prices of these precious stones have increased. Over a period of time, the price will go up. So definitely, the value will also grow up. How much money I have invested here? Only 1.5. So this thing which is worth 1.5 at that time is now worth approximately 2 lakhs right now. So my 1.5 is with me only, but with appreciated value. Getting my point? So that is the reason why our ancestors, our family members are so mad about these things. Don't keep your money idle. If you will keep 100 rupee note in your cupboard, if you will take it out after 10 years, no, it will not reproduce a new 10 rupee note. Only 2 notes will come out. But if you will keep that 100 plus 100, 200 in something which grows, that 200 can become 2000. You never know. Getting my point? So that is the beauty of investing. That is the reason why people invest in shares. That is the reason why people invest in land. That is the reason why people invest in jewelry, etc. The ultimate intention is to put your money in something so that the value of your money should grow over a period of time. It does not remain stagnant. Getting my point? So the money which you have invested in 10 lakh worth of land will grow to 20 lakhs after 10 years. Because the value of land got doubled after 2 years, after 10 years. How much you invested? 10 lakh. Your 10 lakh became 20. The moment you will sell it, no, your 10 lakh will come back and it will bring another 10 lakh. That another 10 lakh which it is bringing, no, is nothing but your capital gain. For that, for the taxability of that amount, this head is made. The jewelry where I put 1,50,000 2.5 years back, yes or no? Now if I go and sell it It is worth 2 lakh rupees right now. It is worth 2 lakh rupees. So if I'll go and sell it, my 1 lakh 50 will come back to me. Additionally, 50,000 will also come. So on that additional 50,000, which is appreciation in the value of my investment, this head is made, capital gains. Got it, sir? Okay. Now pay attention. Rural agricultural land we have covered, no? Okay. Next one. Now coming to gold bonds. Which bonds, friends? Gold bonds. Listen to me very carefully. See, government issued gold bonds. The gold bonds were not issued right now. They were issued in past. In 1977, they issued 6.5% gold bonds. In 1977, that time I was also not alive. I was not in this world. I landed in 1985. Okay. When I was also not alive, in 1977, they issued 6.5% gold bonds. Who issued? Government. Then in 1980s, they issued another gold bonds, 7% gold bonds. And in that same year, 1980s, they issued another bonds, National Defense Gold Bonds. What? National Defense Gold Bonds. So these bonds are not issued right now. They were issued in the past, long back. Now almost 50 years have passed. Almost 50 years. Now these bonds you cannot see in the market. But still, they are given in the exclusion list. Okay, because these bonds are long back matured, but whatever bonds will be remaining with few people, you cannot say. Hence, it is still kept in the definition of capital asset. Now wait, the term capital asset does not include gold bonds. Meaning that if you have any gold bonds, these gold bonds will not be treated as your capital asset. Any profit or gain arising on transfer of gold bonds will not be taxable at all. Why? Because gold bonds are not treated as capital asset only. Why gold bonds? Why they are not treated as capital asset? There is a story behind that. India is a country now where people buy gold. People buy gold. And what they do, they buy gold and store it. They will find n number of reasons to buy gold, but not a single good reason to use it. Whenever there will be, an opportunity to use that bought gold, they will always try to stop themselves, because using it is a little bit riskier. Why riskier? Tell me. If you lose that gold, it becomes of that person who finds it, because your name is not written on that gold. If I lose my gold chain, no, I will never be able to find it. If I'm lucky that somebody has found it, okay, and he saw that it is falling from my neck, if I lose this gold ring, if I'm losing it, somebody who knows that, okay, it is falling from my finger, he has seen it, he'll pick it up. And if he is an honest person, he knows me, then he'll come to me and give it to me. The chances of all these things happening together are very less. So what happens? If I lose it, I lose it forever. It's not going to come back to me. Risk, no. One more risk is there. What risk? People can snatch this thing from me. 4 or 5 people have surrounded me at night, hitting me and taking this away, snatching everything and going away. Risk. If I try to avoid that thing, I'll be hit more. Yes or no? Chain snatching happens. Women are going on the road. 2 or 3 bikers will come. They will snatch the chain and go away. It happens a lot, no? No live example. What are these things? These are the risks associated with physical gold. And see, still we are mad about gold. Still, people are crazy about gold. In South also, and here also. Everywhere the craze of gold is like mad. People are mad. At my house, I'll tell you about my mother. She is also very fond of gold. She's not crazy, but she's very fond of gold. See, earlier, no, my father used to earn for the livelihood at home. So he used to give small amounts to my mother. My mother used to save it. She used to buy small gold coins, biscuits, etc. for some contingencies, that something can happen in future, but at least we are having some money invested in these things. No, it will be useful in our bad times. So people were very smart at that time, and right now also very smart. But now, over a period of time, we are losing all those small things. But my mother always, had this savings habit. Now my father is not earning, I am earning. Okay. So my responsibility every month, without my mother asking, I have to put a fixed amount in her hands. She never demands that. Okay. She doesn't want that money. But as a son, it is my responsibility because she has taken care of me. Okay. Even she does not have a single rupee of expense for herself. She will not go and buy a sari also. But she feels it good. She feels being valued if I give her money in her hands. That okay, no, my son is earning and he is giving me some money. Okay. She will not spend a single rupee out of that, you won't believe. Because there are no expenses which she has to meet. I'm just giving it to her for let her know that she is important. She is still the main lady at home. Okay. So she keeps that money very safe. 2-3 months, 4 months, she'll save that money. And she will ask me one day, today, till what time you are having lecture tomorrow? So the moment I get this kind of question from her, no, I understand that she is interested in going to a jeweler shop. Otherwise, she is not bothered that what time I am taking lecture, what time I am not taking lecture. Okay. So I understand that, because this has been practiced since so many years. No, you come to know about your family members, that what questions they are asking and what are the reasons for which they are asking that. You are never bothered about my lecture timings, and why are you asking? So 2-3 times when she did know, I understood. Now whenever this question comes, no, I tell her, how much money you have saved, Mama? She'll say, this much I have saved. So I was thinking that I tell you that we want to go to a jewelry shop. I tell her that no, I understood the moment you asked me this question. So tomorrow I have a lecture till 5. We are going in the evening. Okay. So I take her to a jewelry shop. And what she will do, she will not buy a single thing for herself. Not buy a single thing for herself. She has only those things which my father had given her long back, 40-50 years back, when they met for the first time. She still wears them. And one, small chain, very costly also, very heavy, which I gave her from my first salary. She wears that. And a Mangal Sutra. Nothing else. She'll never buy anything for herself. Now what happens, no? Whenever I'll take her to a jewelry shop, no, she will either buy gold coins or some biscuit, or sometimes she'll buy small earrings or small chains, etc. for my nieces and all, for my nephew and all. Okay. And 4 times she has bought gold chain for me. 4 times. Those 4 chains are still lying in my cupboard, but not here. She'll not allow me to wear it. When the first time when we went to buy that gold chain for me, I was not aware that she is going to buy a gold chain for me today. Okay. So I went casually. So she said that jeweler to show some gold chains, heavy ones, for a male. I said, for whom you are buying it? He said, shut up, no. She picked up two or three, she chose and showed to me that which one you like. I said, I like this one. Okay. That was what for me? I said, why are you buying? For whom? For you only, my son. When I was driving her back to home, no, that time she told me that she has bought it for me. I was under an impression that some big function or something like that is coming at my sister's home, so she is buying it for my brother-in-law. But it was not for my brother-in-law, it was for me. Okay. I became so happy that day that my mother has bought a gold chain for me and from my own money only. But it is, it is like very happy feeling that your mother is still buying something for you. So I was feeling like a small kid that day, very happy that I'm going to get a new gold chain. I'll be buying that. I'll be wearing that gold chain. Very happy. I came home, and in my house, no, there is a system that whenever we buy some gold or some good happens, no, we always stand in front of our temple and we pray there, and the gold chain or anything good which we bring, okay, which is valuable, we first keep it in our temple. For the full night it will stay there with the God, and then in the next morning we'll do puja and all, and we'll keep it inside. This is a ritual followed since my grandmother's time. My grandmother has given that thing to my mother. So now what happens, that day when I came, my mother kept that gold chain box in the temple, small temple I have at home. So in the morning when I wake up, no, every day it is my ritual. Before start of my day, when I start my day, I every day I pray in my temple at home. I lit a diya and candle and all. So that day, just like my ritual, but I was very happy to stand in front of the God that day, because I was supposed to see that box, and from that box I was supposed to open and I was supposed to wear it. Okay. So morning when I saw, because my mother and everyone at home, they wakes up earlier than me, okay. So when I came in the puja room in front of my temple, I could not find that box, and I was so worried. My God, the chain is very costly. Who has taken? Because maids and everyone comes at home. Too many people come in the morning time, okay. So I was very much worried. I started shouting. I said, Amma, come here. Where is this gold chain box which we kept yesterday? She said, I have put it inside. So the little kid who was very happy yesterday, no, became sad today. Hearing that, the gold chain which was bought for me, I'm not going to wear it. Why? It is not to be worn. It is not to be wear. I'm not supposed to wear it on a regular basis. My mother gave me this reason. Very costly thing. Okay? Not to be worn on a regular basis, not on a daily basis. I've taken it for you only. You are going to wear it, but on occasions. I said, okay. 4 more chains are bought, saying that same thing. Total 4, saying that same thing. Not to be worn on a daily basis. You first manage yourself and take care of yourself first. Then only you will be able to take care of these costly things, no? You yourself fall down many times. How will you take care of these costly items? She doesn't, she still considers me as a small kid that I will, I will lose it. So she has kept that. 2-3 months back, I'm telling you the real story, huh? 2-3 months back, there was a function at our relative's house. So we were supposed to attend that function. Okay, we were supposed to go to Mumbai. Not that close relative, but they were relative. So they had called us. So we were supposed to go, me, mother, father, everyone. So that day I told my mother that, Amma, you remember, no? I have 4 chains. Every time you tell me that this is not to be worn on a regular basis, you have to wear it on occasion. See, today is an occasion. She did not give me that day also. This is not our occasion. At some relative's place. And they are not our very close relatives. They are very relatives from very far away places. I said, what? You have purchased the jewelry for me, the gold chain for me, and you are not allowing it to be used. This is the thing with me also, see. And this is not the thing with me only, it is the thing at every household. We consume gold, but we don't use it. So, what happens now? The gold demand is a lot. People are demanding gold. Marriage happens, gold. Some new child is born, gold. Some function is there, gold. Deepavali, gold. Akshay Tritiya, gold. Dhanteras, gold. Every damn single thing. We have 1,000 reasons to buy gold. I told you, no? But more than those reasons, we have more reasons not to use it. What we do? We buy, and we store it in the cupboards. That way, the demand is too high for gold. Okay, in India. In the entire world, the total production of gold is there now. Out of that total production, India is producing less than 5% of gold. Out of the total production of gold in the world, India is not producing even 5% of gold. Maybe less than that. But out of the total consumption of gold in the world, no, India consumes near about 15 to 20% of gold. This much demand is there. And there is a huge demand supply mismatch. Demand is huge, supply is very less. But to fill this gap, no, to fill the demand and supply gap, supply has to be increased. Supply has to be increased. Okay, so supply will be increased by buying a new gold. Cannot be produced in India. There is no manufacturing process to produce gold. Getting my point? It is extracted from the mother earth, and we don't have that much gold reserves in India. So it cannot be produced. So we have to increase the supply. We have to buy the gold from outside India. Import of gold happens. And whenever you buy the gold from outside India, know what happens? Valuable foreign currency is used as a payment to buy that gold from outside India. Foreign currency reserves are filling up. Okay. And within just blink of second, it gets wiped out. Why? Because we are buying gold. And what people are doing with that gold? Buying, demanding, meeting this demand. We are importing gold so that the supply increases. Now we supply, people demand and we supply. What people are doing? Keeping that in their cupboards. So if people are supposed to do that only, keep the gold in the cupboard only, then instead of keeping the physical gold in the cupboard, keep gold in the paper format, no? So we are giving you an option. Option of what? Option of paper gold. Which gold? Paper gold means gold bonds, which is way more better as compared to your physical gold. And that paper gold is nothing but gold bonds, which were issued at different times. So, yes, it will happen. So that is the reason why imports are to be curtailed. Okay, no? Now what happens? See, if you are told that you are having 1 lakh rupees, where would you like to invest your 1 lakh? In gold or gold bonds? Where you would like to invest? First preference will be gold only, everyone. Hello? Why would I buy gold bonds if I can buy gold? Now, if I'll show that this is more better as compared to physical gold, you will be tempted and attracted to buy this. So rather than demanding gold, you will start demanding for this. Demand for gold will come down because the supply is also less, no? So we have to decrease the demand of gold. So to decrease the demand of gold, we will have to deviate the people to go and invest in other things which are better than gold. So we'll have to give the better opportunity to the investors. Okay, no? So the government came up with the idea of gold bonds. And this has to be better than gold. How come it is better, Gold is very risky. No name is written. You lose it, it is gone. Risky means it can be snatched. Safety issues. Even if it is lying in your locker in the bank or locker in your cupboard, no, still you will be worried about that gold. What if some robbery happens in the bank? What if some robbery happens at my home? Thieves are coming and taking this away. You will be always worried about this. Safety concern, tension is there. Okay, no? No tension. No tension at all. This is not gold. This is gold on paper. Very much safe. No tension. No safety issues. I will prove. Your name will be written here on the bond. So even if you lose this paper somewhere, your name will be written. The person who will find it will automatically come and give it to you. This bond will be of no use to someone else because your name will be on this bond. Okay, no? Very safe and no tension. Wear it in your neck and go out. People cannot snatch it. People will run away from you thinking that you are mad, wearing paper and going out. Safe. Gold value, no? Today 1 lakh rupees you invest. After 1 month, the gold value is 1 lakh 10. Invest 1 lakh in gold bonds. After 1 month, this will also become 1 lakh 10. Its value will be exactly proportionate to value of gold. If gold value goes up, this also goes up. Same proportion. If gold value comes down, this value will also come down. Same proportion. So its value is exactly same as that of gold. But few features, few benefits as compared to gold. Number one, it is safe. Number one, if you lose it, it will come back to you. Okay. Number three, this will give you interest also because it is bond. This will give you only appreciation. This will give you appreciation, same appreciation, but along with that it will give you interest at certain rates. 6.5%, 7%. Do you remember? No? The interest which you will get will be your IFOS income. But don't worry, we will not tax it fully exempt. 10 subsection 15. Fully exempt. And the last but not the least, gold is a jewelry. If you will sell it, capital gain will arise. Yes or no? Whatever appreciation in the value of gold will happen will be taxable in the form of capital gain because it is a capital asset. Gold bonds are not capital assets only. So whatever appreciation will happen will be similar to gold only, same as gold only. But if this appreciation happens in the gold, we will charge tax on this. And the same appreciation happens in gold bonds. We will not tax it only. Because this is not treated as capital asset. Now tell me what is better. If you have 1 lakh rupees, where would you like to invest? Definitely here. Because this is more better as compared to gold. Smart move by the government. So the moment these bonds were issued, they had more features as compared to gold. And the more features were given, deliberately given, to shift the attention of the investor from the physical gold to a new investment avenue that think something out of gold also. Because whenever you think gold, you increase the demand. And to meet that demand, we have to import the gold. And if we are importing, our foreign currency reserves are getting eroded. To stop that thing, we'll have to give you good option. And see, if this step was not taken that time, issuing the gold bonds and all, either the gold prices would have increased beyond imagination or our foreign currency reserves would have become zero. because we had very small foreign currency reserves. We were not able to meet the demand, so we had to import also, because that time the demand was also high. And there were too much of import duties etc. on the gold at that time. But what to do? To meet the gold demand, it was required. Understood, no? Sure. So if you are having gold bonds, which one? Old gold bonds. 1977, 1980s, National Defense Gold Bonds, 7% gold bonds, 6.5% gold bonds, 1977. All those gold bonds are not your capital assets. And if you are earning any interest on those gold bonds, that will be fully exempt under section 10 subsection 15. Will you remember this? Now pay attention. In 2015, no, government came up with a scheme, sovereign gold bond scheme, 2015. Which gold bond scheme? Sovereign gold bond scheme. Under this scheme, on a periodic basis, whenever the government needs money, no, so government issues bonds, different bonds. So under this scheme, whenever the government would want to have money from the people, the government will issue sovereign gold bonds. First issue came in 2015 under this scheme. After that, whenever the government wants money from the public, no, under this scheme only the government keeps on issuing gold bonds. You have this, no? Very good. Okay. So which issue when you bought it? Yes, it has a lock-in period. Has to be, no? Has to be. Because otherwise the people will start, buying and selling. Just like gold. Okay. Now what happens? See here. What happens? This sovereign gold bond scheme, it came in 2015. Under that scheme, whenever the government would want money for its operations, so government always reaches to the public that please pay us some money as a loan. The government will issue bonds. So now this money will be taken as loan only. But the bonds issued will be sovereign gold bonds under this scheme. So if under this scheme the government issue bonds, those bonds will be known as sovereign gold bonds. First issue came, second issue came, third came. If I am not wrong, fourth has also come. 4 times the issues have come under this scheme. Now, are these old gold bonds or new gold bonds? New gold bonds. And the name given is sovereign gold bonds. Capital asset definition exclusions only has old gold bonds. New gold bonds will also be excluded, not written anywhere. So what is the meaning of this? Only the old gold bonds will not be treated as capital asset. Their interest will also be exempt. But there is nothing, no such benefits are given by the government for these sovereign gold bonds. Meaning that if you buy sovereign gold bonds, they are as good as gold. Value will appreciate. There are features better than gold. But now don't expect us to give you some tax benefits for these. Okay. We will consider them as capital asset also. And returns which you get on them in the form of interest. 2.5 or something, very small interest you get, 2.5% or something like that. That interest which you will get on these bonds, no, that interest will also be taxable under the head IFRS. You will not get any exemption for that. Getting my point? So the government does not want you to not demand gold now. The government has also understood that even you all are not interested in buying golds anymore. If you get a better thing as compared to gold, no, will not have to attract you. You will automatically get attracted. Because now the people are educated. Now there is a lot of financial literacy as compared to that time when the old gold bonds were issued. That time people were very adamant. People were very stubborn. If they wanted gold, they wanted gold only. So to attract them, we had to do all such tantrums at that time. Now there is no tantrum required. It will show you that this is better as compared to gold, safe also. So we are not supposed to offer you few tax benefits to come and invest here. This will be another mode, okay, of investment. You can invest your money in the gold, not in the physical gold also, but in the paper gold also. Now the paper gold will be available in the form of sovereign gold bonds. Yes or no? Will you remember this? So sovereign gold bonds is a capital asset or not a capital asset? It is a capital asset. When you will sell it, no, capital gain will arise. But wait, one exception is there. Even though sovereign gold bond is a capital asset, what did I say? Even though sovereign gold bond is a capital asset, if the sovereign gold bond is transferred by an individual, what did I say? Transferred by an individual by way of redemption or maturity. What did I say? By way of redemption or maturity. So you are an individual? Yes. You have bought sovereign gold bond? Yes or no? If you are transferring them by way of redemption or maturity, then whatever gain will happen, no, will not be taxable because that transfer is exempt. That is what lock-in period which you were talking about. Within this much time, you cannot sell. After this much time, they will be matured. And the moment they are matured, you are going to give away your sovereign gold bonds. Against that, whatever money is there, worth of gold, money will be there. That money you are going to get. Fully exempt. Exempt transfer. Sovereign gold bonds are going by way of maturity. Transfer is happening. This transfer is an exempt transfer. But this should go on maturity. Exempt in the hands of individuals only. Exempt transfer. But in any other case, if the sovereign gold bond is transferred, then that transfer will attract capital gains. Because it is also a capital asset, and the transfer other than transfer by way of maturity will not be exempt transfer, it will be a taxable transfer. Getting my point? So I had discussed this. Gold bonds, old ones, they are your capital asset, not your capital asset, sir. Any interest you are getting on the old gold bonds, will it be exempt? Yes, it will be exempt, sir. Now, if you are having sovereign gold bonds, new gold bonds, sovereign gold bonds, which are issued under sovereign gold bond scheme 2015, they will be treated as your capital asset. Any interest arising therefrom will not be exempt, it will be taxable under the head IFOS. And if the new sovereign gold bonds you are having, and if you are an individual, you are transferring the new sovereign gold bonds by way of redemption or maturity, then the transfer of sovereign gold bond by way of redemption or maturity by an individual will be treated as exempt transfer under section 47. Hence, there will be no capital gain. Getting my point? Still it is a capital asset. Capital asset, still there will be no capital gain implications. Why? Because the transfer made by you of such bonds is an exempt transfer as per section 47. Yes or no? But what if that same sovereign gold bonds you are transferring otherwise? Meaning the transfer is not by an individual by way of redemption, any other type of transfer is taking place. You are selling it. You are exchanging it. You are giving it away against some other benefits. Yes or no? That time you are making a transfer by way of redemption? No, any other way of transferring. This will result into capital gains because this transfer is not an exempt transfer. Sure, sir. This is about old gold bonds and new gold bonds and their tax treatments. Did you understand everything? Sure, sir. Now see, what is happening? People are demanding gold. People are demanding gold. Demanding gold. To reduce this demand, you were given new type of asset. Don't invest in gold, no, invest in gold bonds. So instead of you investing your 1 lakh in gold, you can invest that same 1 lakh in another form, in the form of gold bonds. Yes or no? So this was done to reduce the demand for the physical gold. Okay, but wait. Now this can be done only when the bonds are issued. In that year only the demand will come down, or it will come down for the another 1 or 2 years. After 1 or 2 years, again the people will accumulate money. And now people will come out in search of gold, because from 2-3 years they have not bought gold. Now the demand will be more higher. Now what to do? Again issue gold bonds. Government will also have to think, no, every now and then we are issuing gold bonds, we are taking a liability on our head like this, then that is also not advisable. Okay, issuing gold bonds every now and then this investment opportunity will be investment opportunity will be abused. So what to do? Now the people will again start demanding, no? And after demanding, we don't mind meeting that demand if that demand remains once. But they are doing it again and again. Every time when we bring gold from outside India, they will buy and they will put that gold in their lockers, put that gold in their cupboards. Since so many years, we have seen this practice happening in India. Every year we bring new gold, spend money, spend the valuable foreign currency, we bring gold. Hello? With that gold, we meet the demand, people buy that gold, and that gold vanishes. That gold, where is that gold? It is still with the people of India who have bought in so many years. You must not have thrown that gold, no? 100% that gold will be with you only, lying in your cupboards, lying in your lockers. So why to bring new gold for you people? If we can take out your gold only from your cupboards and circulate it in economy. Again a master stroke. At the end of the day, new gold which we are going to bring, you are going to buy, you are supposed to keep that in your locker only, no? Since so many years you have been doing this, so now your lockers would have huge amount of gold. We'll do one thing, we'll come up with a scheme. Gold deposit scheme came in 1999. Under that scheme, no, government made an offer. What do you know? Bring your gold to us. There will be proper places from where these golds will be collected from you. Okay, no, bring your gold to us. What type of gold you will bring? The old jewelry which are not used, gold coins, gold bars which you have kept just for the sake of investing, the gold which you are not regularly using. Okay, no, that is lying in your cupboard. So if it is lying in your cupboard, if you have to keep that gold in the cupboard only, why are you taking that risk of physical gold? Don't keep at your cupboard. Come, whatever gold which you don't use, come with that gold, deposit the gold to us. On a weighing scale, that gold will be weighed. For example, it is 10 gram gold which you are bringing, 50 grams gold which you are bringing, 100 grams gold which you have saved since so many years. This gold which you are bringing, no, the weight of this gold multiplied by the rate as on that day of that gold. Yes or no? For example, 100 grams gold you are bringing, which was not used, which you wanted that, okay, even if I don't have this gold at my cupboard, no, in my locker, will not have any difference. So rather than keeping that gold idle in my cupboard, in my locker, why not to give it to the government? So you brought this 100 grams gold to the government. Government will take that 100 grams. For example, that day the rate of gold is 3000 rupees. I'm not talking about right now. I'm talking about 1999. 3000, 4000 rupees was per 10 grams that time. Right now the values have grown like anything crazy. It's somewhere around 80,000 right now, or more than that. 82,000. Just imagine. 73, 75. So it had hit 80, 82 also, no? Recent past. Again come down. See the fluctuation. Imagine the rate is 73,000 right now, okay? Imagine that time the rate is only 7,000. Only 7,000 per 10 grams in 1999. Still the rate is 10 times more right now. Just imagine. So that time 100 grams gold, 7,000 rupees per 10 gram. So 7,000 into 10. 7,000 into 10. 100 grams will have 10 grams, no? 10 grams gold for 7,000. So 100 grams for how much? 70,000, no? A bond will be issued with a value of 70,000. How much gold you are bringing? What is the worth of this gold? 70,000. We will issue you a bond worth 70,000. Keeping 70,000 worth of gold is better in your cupboard, or keeping 70,000 worth of gold deposit bonds is better? Deposit gold and take the bond from us. Convert your gold into a bond. Okay. Now when this bond you will take at your home, no, this will have all the benefits of the gold. Value will appreciate in the same manner. Okay. Easily transferable also. No problem in that. All the gold bonds, gold deposit bonds are easily transferable, just like your gold. Okay. Easily you can convert that into money also. No problem in that. So when you will bring that 70,000 worth of gold deposit bonds at your home, no, keep that 70,000 with you. But in the form of gold? No, in the form of gold deposit bonds. Safe also. Secured also. Next one, it will give you interest also. Value will appreciate in the same manner in which the gold value is appreciating or depreciating. It will give you interest which will be fully exempt also. And this will not be treated as your capital asset also. So even if you are later on transferring this to have money, yes or no, there will be no capital gains. Better than physical gold. So the people will now be attracted to convert their existing gold into paper gold. We are converting your gold which is lying in your cupboards at your houses into physical gold. Getting my point? Now what will happen here, when you will bring that gold to the government, no, what government will do with that gold, government will melt that entire gold. Small coins will be made, biscuits will be made, gold bars will be made, and that gold will now be again circulated in the economy. Again new gold came in the market, but now this time we did not have to import it from outside India. We met our demand to a very great extent from the existing gold which was lying in our own country. Getting my point? Any type of gold you can go and give. Any type of gold. Not just ornaments. You can give ornaments also. You can give biscuits also. You can give your gold coins. Whatever gold which is lying at your home. Physical gold. Yes or no? Which you are not using. Come and deposit that gold to the government. And take gold bonds. Gold deposit bonds. These bonds were issued under a gold deposit scheme 1999. Okay. Wait, no. At the time of maturity, you are not going to get back your ornaments. That is why we are asking you to bring that ornaments which you don't need. If you want your ornaments, keep it with yourself. No, why are you giving it to us? Why are you depositing? Knowing that now it will be converted into what? Gold bars, gold coins, it will be melted. Now your gold which you are having, no use, then bring here. We will melt it, circulate in the economy. And the bond which you have got, maturity, you will get the money. Whatever money, whatever the worth will be of that gold bond, deposit bond at that time, that money you will get back. At that time, if you would have sold that jewelry also, you would have got the same amount. But that would have that would have been taxed because it was a capital asset. And now this will not be taxed. Your gold converted into money only. Gold converted into your money, and you are not charged tax also. Why? Because it is not a capital asset. Now this scheme is not there. Gold deposit scheme 99 is no more in existence. Now a new scheme has come. Exactly similar to gold deposit scheme. Now the name of this new scheme is Gold Monetization Scheme 2015. And under this scheme, go to the government, deposit your gold. Against that, what you will get? Gold deposit certificates. Thing is same only. Earlier it was gold deposit scheme 99. Under that scheme, if you deposit, you used to get gold deposit bonds. Now the name of that same scheme is changed. New scheme is Gold Monetization Scheme 2015. Under this new scheme, now when you come to deposit your gold, when you come to deposit your gold, what will happen? You will in return not get gold deposit bonds, but surely you will get gold deposit certificates, as good as bonds only. So can I say old gold deposit bonds, not a capital asset? Interest also fully exempt. Hello sir, no capital gain would arise on their transfer. What about the new gold deposit certificates? Definition of 2 subsection 14 capital asset amended. And the year in which gold monetization scheme came, in that year only it was inserted here as an exclusion. Any gold deposit certificates, what did we say? Any gold deposit certificates which are issued under the gold monetization scheme will also be excluded from the definition of capital asset. Even they will not be treated as capital asset. Interest therefrom will also be fully exempt under section 10 subsection 15. Will you remember? So please pay attention. Can you see gold deposit bonds, GDB, issued under gold deposit scheme? Old gold deposit bonds. And can you see gold deposit certificates issued under the gold monetization scheme 2015? New gold deposit certificates. Either you have this or you have this. Both of them are not your capital asset. No capital gain will arise on their transfer, and also the interest on these bonds or certificates is also fully exempt. Will you remember this? Perfect. Nobody does this definition in this much detail in entire India, I am telling you, with this much logic. And now if you'll forget these things, what to say? Don't forget all these things. I can tell you the tax treatments and go away. Then there is no point of coming and studying under me. That can be done by any faculty in India. Why are you coming to me? Why we are studying together? Because you are getting logics. You are getting reasons that why this, why not this, how this. Okay, no? What is there will be told by everyone. That I am also telling you. But why it is there, that also you have to understand, no? What if someone asks you why it is there? What answer you will give? We don't know. It is like that only. You will say like that? You cannot say like that. You have to have some logic also, no? What was the background? Why it was there? So if you speak such kind of things, no, your knowledge will reflect. But okay, this was the reason. Very smart. Who has taught you tax? That time you are supposed to take my name also, huh? Umang sir. Say thank you. Okay. The last one is special bearer bonds. Do you know the gold deposit bonds? No, the government wanted to take out the gold which was there in the lockers and the cupboards of common man. But issuing that gold deposit bonds, no, was a master stroke, and accidentally it was very successful also. Why, government never imagined that this much of the gold will come to us. People have so much of the gold and they will deposit. You know what type of gold came to government under these schemes? Not from common people like us. We are hardly bothered about these things. Right now also, if the government is coming with this kind of schemes, no, we'll always be skeptical. And we'll always be lazy enough to go and participate in these kind of schemes. Seriously, this is the mentality of every common man. Even if knowing about these schemes, even I don't have participated here. Right now I regret that why I have not done it, but still I have not participated here. Because I was lazy. Who has taken the maximum advantage of these schemes, All those people who were black marketeers, earning black money. If you are earning black money in crores of rupees, lakhs of rupees, you are buying as black money. Meaning that is the money which you have earned on which you have not paid tax. Now that money is lying with you and you are very much worried about that money. If somebody catches you with that money, no, you are gone. Especially the income tax department, when they will come behind you, if they will catch this much amount of cash which you had earned, black money. Why black money? This was your income only, which you earned in cash, and you have not paid tax on this money. What you will do, You will not keep that money idle like in currency, paper currency. No, you will use that amount to buy gold. Gold is safer and very convenient to hide as compared to currency notes. They have to be, delicately handled. You cannot keep your currency notes anywhere. What if due to water or due to water leakage or something like that, they are spoiled? Your money is gone. You cannot dig your land and cannot put that cash inside that land. It will vanish after some months only. Entire human body gets vanished below the earth. What about this cash? And just imagine, to store this much huge amount of cash, how much space you would require. Understanding, no? So what usually was done, that these black marketeers, they used to earn what? They used to earn huge amount of money, income in the form of cash. Now they were worried that nobody, see, what if somebody catches us, and we are also worried about the storage of this much cash. Very risky to have this much amount of cash. If somebody comes to know, it will be very difficult for me to safeguard this money. Yes or no? What I'll do, I will use that entire money to buy gold. This much cash I am having can be converted into this much gold. If I am having room full of cash, can be converted into some gold, 2-3 kgs of gold, that will be more convenient for me to handle. So what people used to do, black marketeers, they were the only culprits because of which the demand used to be very high. So they used to convert their black money into gold. Now these people have huge amount of gold lying with them. You won't believe, the moment the government came up with these kind of schemes, no? 2015, you remember? Just 1 year after this, 8th November 2016, demonetization happened. This was the golden opportunity to the black marketeers to convert their black money into gold. Because whenever you'll bring your gold to us, no, either convert your cash into gold and that gold give it to the government. Government will not ask you a single question that from where you are bringing that gold. Without asking a single question, the bonds will be issued. Golden opportunity to convert your black money into white. The government gave this opportunity. In 2015, recent phenomenon. See, no, just after that demonetization came. So those people who were already the insider people, no, yes, for them this thing was done. They had enough amount of cash. Now they wanted all their competitors to go bankrupt. Specific party people. That is the reason why Congress and other governments are not flourishing right now. Their backbone is, affected very badly. So the government came up with this scheme. Why? Because you all are a part of general public, and in this scheme we will write down. Mother swear we will not ask you from where you are bringing this gold. So first, whatever cash you are having, no black money, convert that into gold. Buy the gold. So if you have bought it in the form of gold, now nobody will have any idea that this much was acquired out of your black money. Now bring this gold to the government. Now that gold will be converted into gold deposit bonds. Your entire black money through gold, it got converted into gold bonds, white money now. You still have that much money. And what about others? When this came, no, they did not participate here. And the government was very much aware that they have not participated, because entire data will be there, no, who has given the cash, how much cash, who has given their gold, how much gold they have given, entire data will be available with the government. Now big people whom they wanted to, affect, absolutely they will be affected because they had not participated here. Data was there. So they must be still having their gold, or they must be having their cash. Gold they have not brought us, and now they will bring. We will ask from where you are buying, where you are getting this gold from. And cash they are having, no, demonetize. All the cash they would be having in 1,000 rupee currency. 1,000 gone. Or at the most 500 rupees currency. All the old 500 currency and 1,000 rupees currency was demonetized. And what reason was given? What reason was given at that time? The reason was, we want to break the backbone of terrorism, which is financed by this cash. And immediately after that, 2,000 rupee currency notes also came. Why it came, Many people were still left. They were given another opportunity, that now the government has circulated 2,000 rupee currency notes. No. Now it is more beneficial for us to convert our black money and hold it in the form of cash, because now half of the space will be utilized to store cash, because now the notes are 2,000 rupees. So first their black money they brought here in 2,000 rupees notes. Next what happened? 2000 also closed recently. That is the reason why every other political party is suffering right now. That is why everyone is against BJP. They are very smart people. How to kill their, enemies, political enemies, they know very well. Yes. And new gold scheme also started. Just imagine. Got it, everyone? So, certificates issued under new gold scheme and this. Now see, this special bearer bonds, no, this came in 1991. This was also a golden opportunity for the black marketers to convert their cash into these bonds. Give your cash, currency notes to us, take these bonds. What denomination you want? You want 1000 rupee bonds? We are giving you 1000 rupee bonds. You want 10,000 rupee per bond? We are giving you 10,000. You want one bond worth 1 lakh? Take it from us. But please, for God's sake, give us back the currency which you are holding at your end. Because we need that currency to be circulated in the economy to square off the transactions. Transactions are not getting settled. Liquidity is not there in the market because to square off the transactions in the market, to have the liquidity in the market, the government has circulated currency. That currency is no more circulating in the economy. You black marketeers have kept the entire cash with you. A parallel economy is running. Whatever happening, no, there you will find cash. All the black marketeers will, they will be exchanging the cash. The cash will exchange their hands in the another parallel economy, black market economy, which was supposed to be there in the main economy. It got into the hands of black marketeers. Now the cash transactions are happening. Transactions are getting settled amongst those people only. Government is printing currency, getting into the economy, printing currency, getting into the economy, currency is getting vanished. Where it is going? Parallel economy. Now government cannot print more currency as compared to its gold reserve. So government would have printed more. And just imagine if this existing currency also comes in the economy, the value of rupee will come down. The rupee will be devalued. And which has happened in many countries. Okay. So this much big risk we cannot take. So do one thing. Tell those black marketeers who are holding the cash, 500 rupees note, 1000 rupees notes, okay, these currency notes are with them. Tell them to come and bring those currency notes to us. Against that we are going to issue whatever denomination bonds they want. That is the reason why they are known as special bearer bonds. They are as good as your cash only. So why are you holding so much of cash if you can hold that much amount of cash in specific denominations? No, you tell us what denominations you want to print on that bonds. 10,000 rupees note, have you ever seen? 50,000 rupees note, currency note, have you ever seen? No, these are those notes only, special bearer bonds. Give 50,000 rupees cash to us, we will print 150,000 worth of bond to you. This is as good as 50,000 rupees. Hence it is bearer bonds. As good as cash only. Cash will not give you any returns. This will give you returns also in the form of interest. Fully exempt, 10-15. Since it is a bond, it has to be your asset. And if it is your asset, we will not consider it as a capital asset also. And mothers, where we are telling you that we are not going to ask that from where you are bringing cash to convert into special bearer bonds. Again, the black marketers got a golden opportunity to convert their black into white. But this happened in 1991. I guess P.V. Narasimha Rao, that time he was the Prime Minister. That time it happened. Yes or no? So these 6 points you are supposed to remember, they are not treated as capital assets. That's it. Other than these 6, all the assets are capital asset. ULIPs whose maturity proceed is not exempt under 1010D, those ULIPs are also not treated as capital asset. Shares and securities held by FIIs as per SEBI regulations, they are also not treated as capital assets. They are also treated as capital asset. So, any asset, what did I say? Any asset, any property of any kind, capital asset. Shares or securities held by FII, capital asset. ULIPs whose maturity proceeds not exempt under 1010D, capital asset. And there are certain exclusions. Number one, stock in trade. Number two, movable personal effects. Number three, rural agricultural land. Number four, gold bonds. Which one? Old ones, not the new ones. Sovereign gold bonds are capital assets. Yes or no? Then fifth one, gold deposit bonds or gold deposit certificate issued under the new scheme also, issued under the old scheme also. Both are not capital asset. And last but not the least, special bearer bonds. They are also not capital assets. Now you will go and teach everyone what is capital asset, what is not capital asset, why it is capital asset, why it is not a capital asset. Okay. So this was the first thing, first requirement to come under this head. You should have a capital asset, without which you cannot come in this head. Just because you are having a capital asset, you will come here. You have a capital asset, you will come under this head. No, you will have to transfer it also. By transferring the capital asset, the profit or gain arising, then come here. But for that, you will have to transfer the capital asset also. So what is the meaning of transfer? That I'll tell you. But before that, we have to complete a small discussion, that we have to bifurcate our capital assets into two parts. There are capital assets which will be treated as short-term capital asset. There are capital assets which will be treated as long-term capital asset. Once we finish this discussion, then we are going to learn that what is transfer. So transfer definition, meaning of transfer is very important. So we have just now covered the definition of what? Capital asset. Now your capital assets also can be of two types. Number one, short-term capital asset. Number two, long-term capital asset. Now the discussion of short-term capital asset, long-term capital asset we are going to do. Okay. So the assets can be of two types. Capital asset can be of two types. Short-term capital asset, long-term capital asset. Okay. So once you have to fix that, do you have an asset? Property? Yes. Whether it is a capital asset? Yes. And if it is a capital asset, then it is a short-term capital asset or it is a long-term capital asset. Now, why do we classify the asset into two categories? Okay. Why do we classify the asset into two categories? Why short-term and long-term? See, there are two types of capital gains. Short-term capital gains, long-term capital gains. And the tax rates which are applicable on different type of capital gains is different. Short-term capital gains, if covered by 111A, is taxable at 15%. Now the rate is changed to 20%. Any other short-term capital gain which is not covered by 111A, that is taxable at normal rates. Long-term capital gains covered by section 112 is taxable at 20%. Now that rate has been reduced to 12.5%. This year the changes have come to the tax rates also. Any long-term capital gain which is covered by section 112A, that is taxable at the rate of 10%. Now that is increased to 12.5%. Getting my point, what I am trying to tell you? There are different tax rates on long-term and short-term capital gains. How would you know that at what rate you are supposed to pay tax on the gains? If you don't know the nature of the gains only. And the nature of the capital gain depends on the type of capital asset getting transferred. If the type of capital asset getting transferred is a short-term capital asset, then the nature of the capital gain will be short-term capital gain, taxable at different rates. If the nature of the capital gain is a long-term capital gain, then the tax rate applicable will be 20%, 12.5% as the case may be. Yes or no? That depends. Nature of the capital gain is long-term capital gain. It will be long-term capital gain if the capital asset transferred is a long-term capital asset. Only then long-term capital gain will arise. Sometimes losses can also be there. Okay. Short-term capital loss will be there, no? That short-term capital loss will be set off against short-term capital gain as well as long-term capital gains. Long-term capital loss will be there. Long-term capital loss will be set off only against long-term capital gains. Now, if you are having a loss and you don't know the nature of this loss, you will end up setting off against that gain against which it is not allowed. Or you will end up not taking the set off against that gain against which it is actually allowed. If you don't know the nature, this can happen. So if you want to know the nature of the capital gain or loss, you cannot do it without knowing the type of capital asset. Because short-term capital asset transferred will give you gain or loss, which is short-term. Long-term capital asset transferred will give you a gain or loss, which is long-term. Tax rates are different and manner of set-off is also different. Hence, it is important for us to classify the capital asset either a short-term capital asset or a long-term capital asset. Now, what is a short-term capital asset? That is definition is given in 242A. And what is a long-term capital asset? The definition is given in 229AA. As per 229AA, a capital asset which is not a short-term capital asset is a long-term capital asset. Sir, you have been giving such kind of definitions very frequently now. Yesterday also you gave such definition. Yesterday I gave this type of definition for rural agricultural land. Rural agricultural land is not a land which is not an urban agricultural land. Then urban agricultural land was explained. Likewise, here also, long-term capital asset is a capital asset which is not a short-term capital asset. It is given in this definition. So now it is very important for us to understand that what type of assets are short-term capital asset. What type of assets are short-term capital asset? If your asset is a capital asset, then it will be a short-term capital asset only if its period of holding is 36 months or less. How much period of holding, Kaushik? 36 months or less. What if the period of holding is not 36 months or less? It is more than 36. Then it cannot be short term. Then it will be long term. Yes or no? But this is the main section which says that short term capital asset is a capital asset whose period of holding does not exceed 36 months. This is the main section. 242A says this. But this 242A main provision has two exceptions. How many exceptions? Two exceptions, meaning two provisos are there. Okay. One proviso says that in case of listed securities, then units of equity oriented mutual fund, then units of UTI, and then zero coupon bonds, they will still be treated as long term capital asset even if their period of holding is less than 36 months. See, any capital asset whose period of holding is less than or equal to 36 months, it is a short-term capital asset, no? What if your capital asset is any of these? Their period of holding is less than 36 months, equal to 36 months, still they will not be treated as short-term capital asset. They will be treated as long-term capital asset. Because for them, the period of holding to be checked is how much? 12 months. How many months? 12 months. They will be short-term capital asset only if their period of holding is 12 months or less. What if their period of holding is more than 12 months? They cannot be short-term, they will be long-term. Even if their period of holding is 36 months or less, still they will be long-term. Why? Because for them, the period of holding to be checked is not 36 months, to be checked is 12 months. They will be short term only if their period of holding is 12 months or less. What if 12 more than 12 months? Not a short term capital asset. Then it will become long term. Yes, sir. Less than 36 equal to 36, then yes, then also they will be long term, because for them the period of holding to be checked is only 12 months. Now, two assets, more two assets, another proviso, another exception. Unlisted shares or immovable properties. For them, they can be treated as long term capital asset even if their period of holding is less than or equal to 36 months. Even if their period of holding is less than or equal to 36 months, still they will not be treated as short term, because their period of holding is greater than 24 months. Meaning that for them, in order to call them short term capital asset, their period of holding to be checked is what? 24 months. Here you are supposed to check less than or equal to 12 months, and here you are supposed to check less than or equal to 24 months. Will you remember? So, four assets. Please repeat the names with me. Number one, listed securities. What did I say? Listed securities. Number two, units of equity oriented mutual funds. Number three, units of UTI, Unit Trust of India, units of UTI. And last but not the least, zero coupon bonds. These four assets, if you see these four assets getting transferred, and you are calculating their capital gains, yes or no? Always check 12 months. Always. Will you? Yes or no? If their period of holding is 12 months or less, they will be treated as short term capital asset. And if their period of holding is more than 12 months, they cannot be treated as short term, they will be long term, even if it is less than or equal to 36. Sure. Two more assets. If you ever see these two assets, capital gains, if you are calculating for these two assets, unlisted securities, did I say unlisted securities? This word and this word is different. That is listed securities, this is unlisted shares. There, under the listed securities, shares are covered, yes, covered. Other than shares, bonds, debentures, government securities, they are also covered, but not units, because units are treated separately. So all the securities, shares, bonds, debentures, government securities, etc., they will be treated as short term if their period of holding is 12 months or less, but do it only if they are listed on a recognized stock exchange in India. Okay. What if unlisted shares are there? Unlisted shares are there. Check 24 months. Listed shares 12 months. Unlisted shares 24 months. Yes or no? Listed bonds and debentures. Come on, listed bonds and debentures. Give me the answers fast. 12 months. Very good. Unlisted bonds or debentures. Is it coming under the 12 months asset? No. Is it coming under the 24? No. Then go to 36 months. 36 months. Unlisted bonds or debentures. Yes or no? Hello, sir. Units of equity oriented mutual fund may or may not be listed. Units of UTI may or may not be listed. Zero coupon bonds may or may not be listed. Will not make any difference. For them, 12 months has to be checked. That's it. Unlisted shares 24 months. Immobile property other than rural agricultural land. Why? Rural agricultural land is not a capital asset only, sir. Hello, sir. So other than rural agricultural land, any immobile property, check how many months? 24 months. Will you remember this? Sure, everyone. All other assets, other than these four, other than these two, all other assets, 36 months. 36 months. Jewelry, 36 months. Paintings, 36 months. Unlisted bonds, 36 months. Unlisted debentures, 36 months. all the assets you have to first check that what asset is there. Is this asset getting covered under the 12 months criteria? No. Check, is it covered under 24 months criteria? No. Then for all the assets, check 36 months. Yes or no? Now you will be checking these period of holdings only if only if these capital assets are transferred prior to 23rd July. Meaning the date of transfer of these assets. The date of transfer of these assets should be before 23rd July. Only then check this period of holding. What if all these assets are transferred on or after 23rd July 2024? 23rd July, why this date, sir? See, budget came on 23rd July 2024. Budget after the elections were over. 2024 election year was there, no? So the budget date was 23rd July only. And in that budget speech, our finance minister, honorable finance minister, Mrs. Nirmala Sitharaman, she made this announcement that with immediate effect from today itself, we are not going to give you time. Because if you are going to give you time, no, these assets will be bought and sold very frequently in order to avoid taxes. So the type of changes we have brought, we don't want because of those changes, you try to manipulate the prices of these assets. Okay. So some assets whose period of holding used to be what? 36 months, no? Now 36 months period of holding is no more in existence. For all the assets where 36 months period of holding was required, now it will be 24 months only. Meaning 12 remains same. This 24 also remains same. But the assets for which you used to check 36 months, no. For all those assets, now for them also the period of holding is 24 months only. Why this change was done? Simple reason. There are different types of period of holdings for different types of capital assets. So it becomes very difficult for the department also and for the assessees also to remember that okay, for this asset this much period of holding, this asset, because multiple period of holdings are there. So we want to bring the period of holding of all the assets at parity. Why can any asset be long term if it is 36 months? And why others when it is 24 months? There is no logic for that. But still it was done. So we want to avoid all these confusions and disparities. We want to bring all the period of holdings at same level, and which is possible only if we eliminate 36 months period of holding. So any capital asset, what did I say? Any capital asset, if it is transferred, date of transfer you are supposed to see. What? Date of transfer. The date of transfer of that capital asset is 23rd July or any day after that. Even 23rd July is covered, huh? Or any day after 23rd July. How much period you will take? Always 24 months now. Okay. And if these four assets are transferred, earlier also you used to take 12 months. Now also you are supposed to take 12 months. What about these two assets? Earlier also you used to take 24 months. Now also you are supposed to take 24 only. For all the assets it is 24 now. For the assets which was already 24, no change will be made. It will be 24 only. For the assets which was 12 months, earlier also 12 months, no change will be made. Change is made only for those assets where the period of holding you used to check how much? 36 months. From 23rd July onwards, if these assets are transferred, now you will check how much? 24 months. So in your exams, what is applicable? Both. Yes. Because our previous year is 1st April 2024 to 31st March 2024 25. Now till 23rd July, before 23rd July, whatever assets transferred, no, you will check this. And if the date of transfer of assets is given 23rd July or after that, we'll check new period of holdings. This is only for your return. And January 26. May 26 onwards, no. All the assets, new period of holding. You are special people, no? Got it? ICI is a lot of, concern for you. You should not miss anything. All the amendments came for you, especially in capital gains. Heavy amendments, but very interesting. You'll enjoy. Did you enjoy the first amendment? This is the amendment, huh? Remember this. Okay. Now wait. See what they are saying. If period of holding of any capital asset is up to 36, up to 36 means 36 also, then also short term. Less than 36, then also short term. Yes or no? But for these four assets, the names I wrote there, okay, no, listed securities other than units, because units are covered separately and units are not treated as securities for capital gain purpose. Yes or no? Units are covered separately. So other than units, any securities there, shares are there, bonds are there, debentures there, but they must be listed on a recognized stock exchange in India. All the listed securities other than units. Units of equity oriented mutual fund, units of UTI, units of zero coupon bonds, period of holding to be checked 12 months. Up to 12 months, they are short term. More than 12 months, they will become long term. Okay. In case of unlisted shares and immobile properties, period of holding you will check 24 months. Up to 24 months, short term. More than 24, long term. For all other, you will check 36 months. But you will check this only if capital asset is transferred on or after 23rd July 2024, then in case of all capital assets, now the period of holding is to be checked 24 months and not. Check the same period of holding. 12 will remain 12. 24 will remain 24. But if the capital asset is transferred on or after 23rd July 2024, no, then 36 will now be checked 24 only. Done, sir? Now, what is the period of holding? What do you mean by period of holding? Holding period. For how much time you are holding the asset before its transfer? That is known as what? Period of holding. Now tell me, if you are acquiring an asset, you are purchasing an asset on 12th of July 2016. So you started holding that asset with effect from 12th July. So the date on which you acquire the asset, your date of acquisition of that asset is the date from which you start holding that asset. Till what date you are holding that asset? Radhakshmi, till what date you are holding that asset? Come on, tell me. Till the date of transfer? No. Till the date immediately preceding to date of transfer. Why? Because as on the date of transfer, you are transferring the asset. Somebody else is holding that asset from that day. That is your date of transfer, but it is a date of acquisition for someone else. No. So from that date, he will start holding it. So how can you hold as on that day? You can hold a day prior to that only, no? Till that day only, no? Common sense. So what will be your period of holding? Your period of holding will start from date of your acquisition and it will end on the date which is immediately preceding to date of your transfer. Yes or no? So if you have transferred the asset on 19th May 2024, meaning that your period of holding will be counted till 18th of May. Getting my point, everyone? Don't count it till 19th. What if it is 36 months, one day? It will become long term. Hello? One day here and there your answer will be wrong. It should have been short term because up to 18th May it is, for example, up to 18th May it is 36 only, dot 36. 36 months, one day, it becomes long term. Getting my point, everyone? So, period of holding means a period for which the capital asset is held by the assessee immediately prior to its transfer. This is what is written. Period of holding means the period for which the capital asset is held by the assessee immediately prior to its transfer. Date of acquisition till the date immediately preceding to date of transfer. Till that period you are holding. That is your holding period. And that holding period should be how much? Should be 24 months or less in case of those two assets. That holding period should be 12 months or less in case of those four assets. That holding period should be 36 months or less for other assets. Only then the asset will be treated as short term. What if the holding period, this holding period was more than 36, more than 24, more than 12? Then the asset cannot be treated as short term, it will be treated as long term. But remember, 36, 24, 12, you will check only if the date of transfer of the capital asset was prior to 23rd July. What if this date of transfer is 23rd July or after that? Don't check 36, 12 and 24. Check 24, 12 and 24 now. This has been changed. Got it, sir? Now, see, there is explanation 1. What I wanted to tell you here, pay attention, please, guys. See, the section 242 that tells you what is short-term capital asset. In this section only, short-term capital asset is defined by saying that the capital asset is if period of holding of capital asset is less than equal to 36 months. In some case it is less than equal to 12 months. In some cases it is less than equal to 24 months. Yes or no? And from now onwards this 36 is changed. This will not be seen. Now it will be seen 24 months. Okay. What if the transfer is made? Transfer before 23rd July 24 and transfer on or after 23rd July. So now see, this is a section which talks about short-term capital asset, and in this section only this term is used for the first time. Normally period of holding means what? This section is saying that normally period of holding is the period for which the capital asset is held by the assessee immediately prior to its date of transfer. Date of acquisition to date immediately preceding to date of transfer. Okay, no? But wait, period of holding 242 under section 242A, my mistake, 242A, short term capital asset 242A, no? Under section 242A, this word is coming for the first time. Now, under that section only, there is explanation number 1 to this section, which says that under these circumstances, what did I say? Under these circumstances, this will be the period of holding. If these are the circumstances, no, period of holding will start from this date, or period of holding will be taken from this date to this date. Period of holding start whenever you want, it has to end on this date. Special situations are given. In these special situations, period of holding will not be what you understand. Hello, date of acquisition till the date immediately preceding. No. That is the general thing which are supposed to apply everywhere. But if the case is a special case given here in the explanation to section 242A, in this special case, no, in this special case, no, in this special case, no, period of holding will be this. It will start from this date, end on this date. Or it will start from this date. Or it is supposed to end on this date. These special cases are given here. I will not discuss them right now. Why? automatically in our subsequent discussion, no, every single point will be covered. I will be bringing you here and showing it. See, this was the table which we left. Now, whatever is written here, no, this concept, this point we are discussing in that section. But if I'll tell you something right now, no, you will not understand. You will just have to, keep that thing in mind. For example, if there is a company in liquidation, I'm just giving you an example out of these, some special situation, okay, no? If there is a company in liquidation, you are a shareholder in that company. So the shares of that liquidating company which you are having is your capital asset. What will be your period of holding of those shares? It will be from the date on which you acquire the asset till what date? Till the date you are surrendering those shares to the company back, or till the date of liquidation? Explanation says that in the case of shares of a liquidating company, the period after the date of liquidation should not be considered, ignored. Meaning the period of holding of these type of shares will be till date of liquidation only, because as on the date of liquidation, company is dying. If company is no more in existence, definitely shares are not going to be in existence after the date of liquidation. So why are you counting the date after the date of liquidation till the date of your surrender? No, till the date of liquidation only you are holding these shares, because till the date of liquidation only the company is in existence. Understanding? So this I'm going to discuss with section 46. When I'm going to do section 46, this point will be automatically covered over there. Now what if there are certain cases in which you acquire the asset, but you are not paying money to acquire the asset, you are getting the asset by way of gift, you are getting the asset by way of will, you are getting the asset by way of what? Inheritance, etc. See, the person giving you that asset by way of gift, for him the transfer is exempt transfer, because he is not getting any money to transfer that asset. Yes or no? If I am giving you my asset, for example, I have this asset. Okay. See, this is my capital asset. I am gifting you this asset. Take this asset. Gift. Am I getting any consideration for transferring? No. So no capital gain will arise. For me, the transfer is exempt transfer as per section 47. But for you, have you acquired the asset by way of gift? And gift is a mode given in section 49.1. So there are many modes which are given in section 49.1 because of a mode which is specified in section 49.1. You have acquired the asset. And those modes are gift, will, inheritance, many other modes are given. So because of those modes, if you are acquiring an asset, what will be your period of holding? The date on which you have acquired the asset by way of gift. From that date only you are holding the asset, no? Do one thing. Include the period of holding of the previous owner also in your period of holding. Check the total period of holding. Not from your date of acquisition. Check from the date of acquisition of the previous owner. Because you have acquired the asset by way of mode specified under section 49.1. In these modes, if you are acquiring any assets by way of gift, will, inheritance, blah blah blah, many modes are given. If the asset you have not purchased, no, you have not spent the money and purchased the asset, you are getting the assets by way of these modes which are given in 49.1 from any previous owner. Please include the period of holding of the previous owner also in your period of holding. Check the total period of holding. Not from your date of acquisition, but from the date of acquisition of the previous owner, the period of holding will be counted. Getting my point? Previous owner also inherited, then the first previous owner, that also the period of holding of that previous owner will also be counted. That is the reason why I am not discussing these things right now. Kaushik, are you understanding? See, being curious is very good, but being extra curious is sometimes dangerous. And that is the reason why I am not discussing right now, because there are many things which will creep up in your mind and I will not be able to address them right now because the correct time has not come. So don't worry, whatever these cases are there and what is the period of holding to be taken in these cases, I will explain each and everything at correct places. then in the end, no, we'll come to this table and I'll say, have we completed section 46? Yes. We have checked this period of holding there only. Do you remember? You say, yes, sir, we did this there only. It is just a tabular format in which everything is presented for you all to have period of holding at one place. That's it. Will be covered automatically in subsequent parts. Don't worry. Okay. So can you see explanation 1? Explanation number 1 to section 242A. Can you see this? Different cases. Different cases. Against that, they are saying period of holding ends on this date. So in this case, your period of holding will end here. In this case, your period of holding will be taken, but also include the period of holding of the previous owner. Likewise, many cases are there. Yes or no? We are going to do all the cases step by step. Don't worry. We are going to ignore this table right now. Now, coming to this section. Read it once. What is short-term capital asset? 242A. What is short-term capital gain? 242B. Any gain arising on transfer of a short-term capital asset will be treated as short-term capital gain. Full stop. Is it something which you did not know? You know this, no? Now, what is long-term capital gain? 229B. Long-term capital asset? 229AA. Long-term capital gain? 229B. Definition. Long-term capital gain is a capital gain arising on transfer of a long-term capital asset. This also you know, na? It is just formally given in a section defined. Now see, if the period of holding of a capital asset up to 36, 24, 12 months, hello, then it is short term. Hello. More than 36, 24, 12 months, then it is long term. Please check 36, 24, 12, 36, 24, 12 only if the capital asset was transferred prior to 23rd July. What if the capital asset is transferred on or after 23rd July, sir? Then check only 24 months and 12 months. 12 months for those 4 assets, and for all the other assets check 24 months only. For 24 it is going to remain 24 only, but for 36 it will become 24. I have already told you this. Now pay attention. Capital asset done. Type of capital asset done. Now see, capital asset is there. Will you calculate capital gains? Just because you are having a capital asset, will you calculate capital gains and pay tax? When are you supposed to calculate capital gain? This capital asset should be transferred also. Only on the transfer of the capital asset, capital gain will arise, will be calculated. Otherwise, no calculation of capital gain only. Section 48 is not applicable only. Computation of profit and gain, capital gain is not to be done only. So, two most important conditions. Capital asset should be there. Transfer should also be there. Now, what is transfer? See, from one person to another person, if the ownership or the possession of the capital asset getting changed, ownership or the possession of a capital asset getting changed from one person to another person voluntarily for a consideration, it is a transfer. Now you want to call this transaction by any name, you can call it, but this will be transfer. There must be two parties, the person who is transferring and the person to whom it is transferred. The person who is transferring will be transferor. The person to whom it is transferred is transferee. Yes or no? Transferor, transferee. Two parties should be there. Second, between them, the ownership or the possession of the asset should change. Meaning the asset should change hands. From one person, it should go to another person. Ownership from one person should go to another person, or possession from one person to should go to another person. Forcibly, no, voluntarily. He wants to give and he wants to take voluntarily. And there is some consideration also involved. Now you call this transaction by whatever name, we don't want to listen also. This transaction happening by satisfying all these conditions will be treated as transfer. Capital gain will arise. Keyboard you are having, no? Keyboard or mobile you are typing, no? Switch off your keyboard. Switch off your keyboard. Not supposed to type anything, Kaushik. Please. Why? Because you are in a hurry. Don't be in a hurry. No, be with me. No, please, macha. Why am I telling you? Why I am telling you? 14 years experience. Now this is my 15th year. See my beard. Entire white. Even I have a grey hair. I have covered them with dye. 14 years experience. I know how to go with this. Go with me in a flow, macha. You will understand everything. I know when to cover what thing. If I am telling no that this concept is done, okay, then ask me the doubt. If you will ask me, I will not be able to tell you. Don't be in a hurry. Don't run ahead of me. You will lose many things. And if you will stay with me, you will have such a confidence in this chapter. No, you will never go wrong in this chapter. Okay? See, this is this is triangle. Triangle means change. This is a sign which you use for change. Change of ownership or possession of a capital asset from one person to another person voluntarily for a consideration. This is the ordinary meaning of transfer. Meaning that there are many case laws, many judgments which have taken place, and taking the crux of all the judgments. This is the final understanding of the term what? Transfer. But the term transfer is defined under section 247 also. And the definition is inclusive definition. Meaning that whatever you understand is a transfer. We don't deny it. But these things will be specifically treated as transfer. Meaning that the meaning of the term transfer is widening. These things are also transfer. If anything like this happens with your capital asset, meaning that your capital asset is transferred, capital gain will arise and you will have to pay tax on that capital gain. Hello, sir. Any of these things happening, number one, sale, exchange, relinquishment of capital asset. Sale of capital asset is a transfer. We consider this as a transfer. You say sale, no problem. Sale is a transfer. Even you exchange your capital asset with someone, that is also transfer. Just imagine if exchange is not treated as transferred, who will sell? Everyone will say, take my asset and give me your asset. Nobody will take consideration in cash. Everyone will start taking consideration in the form of other asset. Just to avoid capital gains tax. Getting my point? So even if you exchange your capital asset with someone and that person is giving you another asset for transferring your asset to him, this exchange is also a transfer. And now in the case of exchange, you both will pay capital gain tax. You are also transferring your asset for some other asset and that fellow is also transferring his asset to you for your asset. Both will pay capital gain tax. Getting my point? Next one, relinquishment of capital asset. Sale is a transfer? Yes, sir. Exchange is a transfer? Yes, sir. Capital gain will arise? Yes, sir. Even the relinquishment of capital asset is a transfer. Do you have a capital asset? Yes. You relinquish. Relinquish means what? Give away. Give away your asset to someone. Make yourself away from something is known as relinquish. I was crying when I was a kid in a supermarket. My mother relinquished me there only. She left me there. Meaning what? Giving away. Giving away your asset to someone. Why would you give away your asset to someone? Capital asset is not a small thing, no. Valuable asset. Why would you bloody give away your asset to someone? Why would you relinquish your asset? You must be getting something in return, which is not an asset, which is not cash. If it was asset, if it was cash, it would have been definitely what? Sale or exchange, it would have been transfer. But now you are getting something else in return, which no one knows that what you have received. You're a partner, you are a person, you want to get entry in a partnership firm. You want to get entry in a partnership firm. So that partnership firm is saying that you will have to bring capital, 10 lakh rupees. So what you are doing, you are bringing 10 lakh rupees in the partnership firm because you are getting admitted as a partner. The 10 lakh rupees when you will bring, the 10 lakh rupees when you will bring, the partnership firm will pass an entry, cash bank account debit to partner's capital account, 10 lakh, 10 lakh. Yes or no? But you did not have 10 lakhs, you had only 5 lakhs. You are bringing 5 lakhs in cash and one asset is also there. This is also worth 5 lakhs. So you are telling the partnership firm that, see, partnership firm, I acquired this asset long back for 1 lakh. My cost of this asset was 1 lakh. Today the value of this asset is not 1 lakh. Today the value of this asset is 5 lakhs. See, I wanted to bring 10 lakhs. No, I am bringing 5 lakhs in cash and 5 lakhs worth of asset I am bringing right now in the firm as my capital contribution. Is it okay? Firm will say, no problem. Bring asset also. Now what entry the firm will pass? Cash bank account debit, 5 lakhs. Asset will be recorded at the current market value, not at the cost which I incurred. What was the current market value? 5 lakhs, no? 5 lakh rupees asset debit to partner's capital account 10 lakh. Did you get the credit of 10 lakhs? In that credit, you got a credit of 5 lakhs also for this asset. Now, immediately if you leave the firm, how much you will get? 10 lakhs? 5 lakh, the cash which you have given will be returned. Now you will not take away this asset. In return, you will take 5 lakh rupees cash. You very smartly transferred your asset. Nobody came to know. The moment you gave this asset away to the firm as your capital contribution, see, I am not selling. No, I am not selling. No, I am not exchanging. I am just giving away my asset to the firm so that I can get a credit in my capital account. Relinquishment. Because now whatever credit you have given, whatever credit was given to your capital account for this asset, 5 lakh rupees, no? Now whenever you will be leaving that firm, that amount you are going to get from the partnership firm. People used to transfer their assets like this and saving taxes. Relinquishment also transfer. Sometimes buyback is there, buyback. Company is buying back the shares. At that time, just forget about buyback. I'll tell you, buyback is another example. Have you heard about right shares? The company is giving right shares. But it does not give right shares directly. What the company will do? Company will give rights to the existing shareholder. That if you want, the company is issuing right shares in 1:1 ratio. Existing shareholder will have a preference to buy one share, right share, if he is having one share in the company. If you are having 2 shares, you can buy 2 more shares at a very low price. The price offered to general public for this will be higher, After 10 days, you can see, after 10 days, we are going to issue the same shares to outsiders. If you are not buying from us, we are going to issue to the outsiders. And see, from outsiders, no, we are going to take 200 rupees per share. You are the shareholder, no. You are getting a right to buy 1 share if you are having 1 share. It can be in any ratio. Right now I am saying 1:1. It can be 2:1 also. It can be 4:1 also. It can be any ratio. So if you are having 1 share in the company is giving you a right to acquire 1 more share at a very less price. You have a right to acquire one share at a very less price of 120 only. This right you are getting from the company. If you exercise this right, right shares will come. Right will get converted into right shares. What if you don't exercise this right? Certain period will be given that within this period you have to exercise this right, otherwise the right will lapse. Yes or no? And that period will be some days only, a week's time or 10 days time. Okay, no? Within that period only you are supposed to exercise the right and buy the right shares. If you don't exercise, no, period over, the right will lapse. So you don't want to buy. You don't want to exercise the right to buy. You want to exercise the right to renounce. You want to exercise the right to give away this right to someone else. Because you are having two rights. The single right is giving you two options. Either you exercise this and buy right shares at a very concessional price, or you have a right to give away this. You have an option to give away this right to someone who is not a shareholder. So which option you are exercising? Exercising the option to acquire the right shares. Right will get converted into right shares. You will get right shares at a very cheaper cost. But if you are exercising the option to give away your right to someone else, are you giving away right? Meaning, are you giving away your intangible asset? Intangible asset right. Any type of asset. Tangible, intangible, movable, immovable, fixed, circulating, used for business or not. Any type of asset is a capital asset. So right is an intangible. It is any type of asset. It is your capital asset. So what? It is coming for you for certain number of days. But because of this right, you will get some benefit, no? What benefit you will get? You will get the benefit of buying the shares at cheaper cost. Or you can give this right to someone else. Someone else will get the benefit. In return, he can give you something. What are you doing? You are renouncing your right. You are exercising this option to renounce your right. Renouncing means giving away your right to someone. Giving away, renouncing means relinquishment of capital asset. Capital gain will arise here also. Because if you are giving this right to someone who is not a shareholder, and if that person will now buy the shares by exercising the right to acquire right shares, he can buy the shares for 120. Is he going to get benefit? Yes. So he'll ask for 20 rupees per right. Give me 20 rupees per right, I will give you one right. You will get the shares at 120. Still the shares will cost you 140 only. When it will be issued in the market, no, it will be issued at 200. So you want to buy it at 120? Yes. Yes or no? Take this right from me. Buy it at 120, but give me 20 also for one right. Are you relinquishing and getting something? Should it be taxed? Yes. It will be taxed only if relinquishment is transfer. Hello, sir. Sale of a capital asset, transfer. Exchange of a capital asset, transfer. Even the relinquishment of capital asset is also a transfer. Relinquishment, two best examples I gave you. Okay. Fourth one means second point. Extinguishment of right in a capital asset is also a transfer. There is a capital asset, but your right in that capital asset is extinguished. It is as good as transfer of that capital asset. It is not necessary that in order to transfer a capital asset should go from you to another person. No. Sometimes your right in the capital asset also vanishes, extinguishes. That is as good as transfer of a capital asset by you. Transfer of property, yes. Best example, me, my two sisters. Okay. We are the members of our father's HUF. Now what will happen? Whatever properties HUF is having, no, in that properties, even I have a right, and in that property, even my sisters will have a right. Yes or no? But they are married. They are married. But still, married daughters have a right in their father's HUF. Yes or no? So in my father's HUF, both my sisters, meaning the daughters of my father, meaning my sisters, even they are having a right in the property, no? So they are giving away their right to me. Right in a property, if they exercise that right, they are going to get the property. But now they are not taking the property, the right in that property which they are having, no, they are extinguishing it. They are saying, brother, we don't want any share in the property, even if we have a right to ask for, even if we have a right to ask for that part of property which belongs to us, father's property, yes or no? We are giving away our right. Extinguishment of right. Whatever amount I'll give to my sisters, no, for this extinguishment, that will be taxable as capital gains in their hands. No need to transfer asset. If you have a right in an asset, even that also you vanish. It is a transfer of capital asset. No need to transfer the asset really. They get the property, then they sell the property. No. Even their right in the property, they vanish, extinguish, and against that also they get some money. Even that will be treated as transfer. Buyback, have you heard? Buyback. Shares are bought back by the company from their own shareholders. So once the shares are issued, you become a shareholder. Now that same company you are shareholder of, yes or no, same company asking you to return that shares to them. You had a right in the company by having these shares, right of ownership represented by the shares. Ayyo. The company, you gave the money to the company. The moment you are giving the money to the company, no, pay attention. This is a company, okay? This is a company. Now, if you put your money in the company, meaning you are contributing to this capital of the company. Out of this capital, 25% you are contributing. Out of the total capital, 25% you are contributing. Means 25% of the capital of the company is contributed by you. It is your share in the company's capital. Meaning you have 25% ownership in the company. And that ownership is represented by shares, because the company will give you 25% shares, no? Out of the capital, 25% is shared by you. So that is represented by the shares which the company will now issue. That is an evidence that you have a right of ownership to the extent of 25%. Whatever profits are there, whatever capital is there, whatever assets are there, 25% of that belongs to you. Sure. So you have a right of ownership represented by the shares. Now these shares are taken away in buyback. What are you giving? Shares you are giving. But along with the shares, your right of ownership also you are surrendering, no? Hello? When your right of ownership you are surrendering, meaning now your right of ownership will vanish the moment you are giving back your shares. Shares was a evidence that you have a right of ownership in the company because you have contributed 25% over here. Hello? But that shares which represent the right of ownership, when the shares will be bought back, you will be giving away the shares. Give me money, I will give the shares. And once the shares are given back, those shares will be cancelled, meaning your right of ownership comes to an end. There is an extinguishment of right resulting into capital gains, because that is also a transfer. Hello, sir. What if you have one asset? Okay. Due to some natural calamity, asset is damaged or destroyed. Possible or not? Tell me. Due to some natural calamities, asset is damaged or destroyed. Asset will remain or it will not remain? It will not remain because it is already damaged, gone. Asset is gone. So your ownership in that asset also gone. No, there is extinguishment of right also. Will result into capital gains. Why? Because the insurance company will now give you money for this extinguishment, for this damage or destruction, meaning extinguishment. Even that should be taxable under capital gain. But in order to charge tax on these transactions under the head capital gain, because under these transactions, no huge profits happen to the assessee. They can be brought to tax under the capital gains only if these type of extinguishments of a right in a capital asset is treated as your transfer. We want to charge tax on those gains. Possible only if extinguishment is treated as what? Transfer. So sale, exchange, relinquishment, no, it is a transfer. But even extinguishment of right in a capital asset, no, there will be two sections where I'll be referring this word. 46A, buyback. 45(1)A, damage or destruction of a capital asset due to some reasons. NRFE, natural calamities, riot or civil disturbance, fire or explosion, enemy attack. Because of these reasons, your asset is damaged or destroyed. Asset does not remain. So my right of ownership in that asset is also vanished. No, extinguishment of right also happening. In these cases, capital gain will arise. So when I will be teaching you the capital gain calculation in these cases, that time I will refer this extinguishment. See, I told you no, extinguishment is transfer. Extinguishment is happening, meaning this is a transfer. Hence we are calculating the capital gain also. That time I am going to tell you this. Getting my point, everyone? Ordinarily, what is the meaning of transfer? That is easy. But these things we want to specifically cover. Because if anything given under this definition happens with your capital asset, there are huge gains happening to you. On those gains, we want to charge tax. We will be able to do it only if we consider all these things as a transfer. All these transactions we consider as transfer. If we don't consider these things as a transfer, you will not pay tax. What you will say? Asset is gone. Let it go. Money is earned. Let it come. Profit happening. Let it happen. I will not pay tax. Why? Because I have not made a transfer. This is not a transfer because all the important ingredients of transfer are not present in my case. So even if these are not present, no, not to worry. If it is covered here, no. Even if these things are not present, will not make any difference because they are specifically treated as transfer. Getting my point? Capital gain you cannot deny if anything like this happens with your capital asset, because this is transfer. Not ordinarily, treated as transfer. Treated as transfer, included in the definition of transfer. Yes or no? Next one. Are you giving your asset on your own? Or it is taken away? Compulsory acquisition of the asset is taking place. Even if you are not giving your asset, authorities or the government under any law, they are taking away your asset. Compulsory acquisition taking place. That time also the profit and gain will arise. How much, how to calculate, that we are going to learn in 45.5. To charge tax on that capital gains, under capital gain side, specific charge is there. But in order to charge that gain under that specific charge section, this transaction should also be treated as transfer. Because without transfer, there cannot be any capital gain. So even if you have not voluntarily given, they have taken the asset from you. Still, we consider this also as a transfer because profit gain will arise here also. And we want to charge tax on this profit and gain. Getting my point? That is possible only if we consider this as a transfer. You have an asset. See, this asset you are having. When you bought this asset, it was your capital asset. You bought it as a capital asset. My capital asset. My capital asset. Now all of a sudden what is happening to you, I don't know. Today you are converting your capital asset as stock in trade. Now it is my stock in trade. Have you converted your capital asset into stock in trade? Is it leaving you? Going to some other person? No, two persons are not involved. You only. Earlier you were saying that it is your capital asset. Now you are saying that it is your stock in trade. Meaning you are converting your capital asset into a stock of your business. You are converting it into inventory of your business. Getting my point? Asset is not leaving you anywhere. No second party is involved. And bloody you are not getting any consideration also. It is merely an adjustment which you might be doing in your books. Still on that conversion, no, some gain will be there, which you might not receive. But we have an eye on that gain, which we want to charge tax on. Will be possible only if we consider conversion of your capital asset into stock in trade also as a transfer. 45(2) we are going to do specific charge. In that I will tell you, see, do you remember section 247, conversion of capital asset into stock in trade was treated as transfer? Now this is the logic for this. Right now just remember that if conversion is happening of a capital asset into stock in trade, even that conversion is also treated as transfer. Because profit or gain arising on conversion, we want to charge under the head capital gain. It will happen only if this is treated as transfer. Sure. Next one. If you have a zero coupon bond and there is a maturity of that zero coupon bond. Do you remember zero coupon bonds were issued? 1000 was the face value. It was issued at 700. Same example we did in PGBP. 1st October 2024. They were issued for a period of 3 years, 36 months. Whenever they will be matured after 3 years, you are going to get what? 1000 rupees face value back. Right now you just give us how much? 700 issue price. 300 benefit happening or not? When? Right now only? Or at the time of maturity? Maturity, no. At that time we want to charge that 300 rupees in your hands as capital gains. Possible only if we treat this transaction also as transfer. Otherwise maturity or redemption is nothing but amount which I gave is coming back to me. How come it is my transfer? But the amount which you gave was less compared to the amount which you are getting back, which is more. So profit is hidden in that amount in terms of discount. And we want to consider that discount as your capital gain. We want to charge that discount under the head capital gain. Yes or no? That is not in the nature of interest which you missed. For these 3 years you did not get interest. Against that only you are getting that 300 rupees discount. No. Because zero coupon bonds you are not getting any interest. So for zero coupon bonds, if you are not getting any interest, again that interest only, this discount is there. So you would want to treat this as your interest. This is in lieu of interest coming. And this type of interest cannot be taxed anywhere because this is not regular payment, it is a capital receipt. You will say it will not be taxed only, but we want to charge this amount to you under the capital gains only. This is your benefit. The amount which we gave as a deduction to the company pro rata basis 36(1)(3)(a), that same amount we want to charge you under the capital gains. That is possible only if we consider this maturity of zero coupon bonds as your transfer. At that time the capital gain will arise. This 300 will be chargeable in your hands at that time. But to do that, this has to be your transfer. Getting my point? Next one. Now sir, the doubt which you had, it is coming here. Read it. Handing over the possession of an immovable property. Handing over the possession. Not necessarily with ownership. Maybe without ownership also the possession can go, no? Will it be treated as transfer? Absolutely yes. If the transaction is complete in all aspects. This same transaction we have seen in section 27, deemed owners, under the head house property. Do you remember? Even if you have not acquired the legal ownership, you have acquired the asset, acquired the building, possession of the building, still you will be treated as deemed owner. If you have given consideration, the seller has given you possession, sale agreement is made, but it is not yet registered. So till the time it is not registered, who will pay tax? You only, because you are deemed owner. So if the buyer is already considered as a deemed owner, so seller should have been considered that he has transferred, no? The moment he has given the possession, not necessary registering the property. What if the property never gets registered? Meaning that you have never transferred, you have already transferred bloody. Part performance of a contract. Your part of the contract you have performed as a seller. Buyer's part he has performed. Buyer has given you consideration. Or he has taken the liability to give you consideration. Hello. And as your part, what you are doing now? Now you are allowing to take the possession. You are giving the possession to him. In return of his part, he has done his part. Now you are supposed to do your part of the contract. What? You will give the peaceful possession. This is given in the contract. Hello. Sale agreement. Which you are not going and getting registered now. When it will be registered? After 2 years? Possible. After 6 months? Possible. It is also possible that it is never registered. Power of attorney given. So what do we feel? That you have not made a transfer. You have made a transfer. Even bloody giving possession of immobile property. Even if that legal title deed is not legally registered on the name of buyer, still the seller has made the transfer by just giving the possession. Hello. Giving the possession of the, allowing the possession, not acquiring. Acquiring is deemed owner. Hello. But allowing is transfer. Allowing or handing over the possession of an immobile property without a transfer of legal ownership. Have you transferred the legal ownership? No. But have you given the possession of immobile? Yes. As a part performance of contract. Title deed of the property is not yet registered on the name of the buyer. That does not mean that seller has not done the transfer. Seller has done the transfer. On possession only, the capital gain will be calculated. Hello. Because giving away the possession is also treated as transfer. Will you remember this? Sure. Next one. Right to enjoy ownership. You all must be living in a building, no? Or row houses. Building? See, I stay in a building. The name of my building, no? The building in which I stay, this is the entire structure, okay, no? I'll tell you one. This is the entire building. Now, our building is having what? 4 flats each on one floor. Okay. How many flats? 4 flats. So, per floor, 4 flats. And there are 5 floors. 4 floors, in fact. Wait, your top floor, first floor, ground floor, first floor, second floor, third floor, fourth floor, fifth and sixth floor. For example, these are the number of floors in my building. Okay, every floor has 4 flats. So can I say there will be one owner of this flat? There will be one owner of this flat. there will be one owner of this flat. Every flat will have single owner. For example, this is my flat, or example, I'm saying this is my flat. I am saying this is Umang sir. Umang sir is saying that I am the owner of this flat because I have given the money and bought the flat. Okay, no? So I am saying I am the owner of this. Now wait. I'll tell you one thing. In such huge buildings, now what happens? There are multiple owners of multiple parts of the building. Parts means flats. And there are common places also. Like garden is there. Okay. Big swimming pool, clubhouse, etc. is also there. The land is there on which the building is constructed. So there is a big piece of land. Okay. There is a big piece of land. On that land, the building is constructed. Now, this land is also a part of the building, land and building, entire structure. So, if I am the owner of one part, to that proportionate extent, I am the owner of this land also. So, for example, if I am the owner of this part of the building, then I'll be having a proportionate ownership of this much land. If he is the owner, okay, no, this fellow is the owner of this part, so this fellow will also have some portion of the land, proportionate ownership of the land. So everyone will have proportionate ownership of land. Okay, no, I don't want to stay here. I don't want to stay here, so I'll sell my property, but I want my land back. Can I take it? I will ask for the proportionate part of my land. No. If I am the proportionate owner of the entire structure, including land, so I am not just the owner of that structure. Along with that structure, I have the proportionate ownership of the land also. So if I am selling this, but I don't want to sell my land, very valuable, and I need that for my purpose. Remove the building from my portion. I want to use that land. Can I do it? But in future, mad people like me can have a flat over here. And they can ask for such kind of things, no? So, to avoid these things to happen, no? Whenever these type of properties are constructed, big properties having multiple flats, multiple parts, having different person as owner of different parts. So amongst them, there should not be clash for the structure and the land. If that happens, the situation will be out of control. So an idea. This entire structure and the entire land, a cooperative society will be formed. Cooperative housing society, housing association. In Chennai, housing associations are there, no? Here, there are also housing association. We call it cooperative society. Cooperative housing society. Now, this cooperative housing society will be formed by the builder who is constructing this. So, the builder will acquire the land, title of the land. Hello? The builder will construct the structure, building. So builder will be the owner of the land as well as the structure, building. Builder has constructed. Builder is the owner of this entire property. Now wait. Builder knows that I am not going to sell this entire land and building to one person. I am going to sell this to multiple people, These many flats are there. These many owners will be there. Tomorrow, everyone will start fighting for their each share. If I give the ownership of each part, so they will be having the ownership of each part. Hello. Accordingly, they will be having the ownership of that same proportion of land over also there. So they will be fighting for their respective parts. And somebody will say, I don't want to keep my part here. I want to shift it to the top floor. I want to break it. I want to have that portion of my land. I want to do agriculture over there. Everyone will start doing, asking for these undue things, no? So builder knows this, that this is going to happen. This will ultimately, all the members, all the owners who are staying there, they will come for these kind of fights. Do one thing, don't allow anyone to have ownership in the land and structure. Nobody will have ownership. No, 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 no. You are not the owner. Owner of this land is a cooperative society. Owner of this entire structure is the cooperative society. Now this structure does not belong to you. Okay. Even if you are living in the structure as an owner, no, you don't own the structure. You don't own the land. It is owned by this cooperative society. So our building, no, what is the name of my building? It is Harmony Shivai. So our society is registered on the name of this Harmony Shivai Cooperative Housing Society. So the Cooperative Housing Society registered on this name Harmony Shivai Cooperative Housing Society Limited. Now the builder, what he has done, entire structure ownership given to cooperative society. Entire land ownership given to cooperative society. Now the entire structure and the land which is there, no, you all will enjoy together. To enjoy this part as an owner, no, to enjoy this part as an owner, to enjoy this part as an owner. How many parts are there? Come on, 6 floors. How many floors? 1, 2, 3, 4, 5, 6, 7, 8. 8 floors are there. Each floor having 4 units. 32. 32 equal shares. This cooperative society will have 32 equal shares. This cooperative society will issue 1 share to me, representing my ownership. Representing my ownership. I am getting the right to enjoy that part, 1 share. Out of the total 32 shares, I am having 1 share, 1 flat. I can enjoy that flat as an owner. I am not the owner. I am not the legal owner of that part. How can I be the legal owner of that part whose legal owner is somebody else? If this somebody else is the legal owner of the entire structure, I cannot be the legal owner of that. I'm just enjoying that part as owner. Why I'm enjoying that as an owner? I've got the right to enjoy that part as an owner, and that right is given to me by issuing 1 share, which is equivalent to my flat. Getting my point? So whenever you buy a flat in a society, no, cooperative society, big buildings and all, you don't get the ownership of the flat, because that cannot be owned by you. That is already owned by that society. Legal ownership, legal title is with that society. But still you call yourself as an owner. Why? You are not the legal owner. You enjoy the ownership right given to you. Hence you call yourself as an owner. And that ownership right comes to you. That cooperative society issues 1 share to you. Because of that membership, because of that shareholding in that society, you now get a right to enjoy this part as an owner. Hence, you call yourself as an owner, but you are not the legal owner. Now, just imagine if you give this right to someone, if you transfer this membership or transfer this share to someone, it is as good as you are transferring your immovable property. This is also a transfer of immovable property. Transferring the right to enjoy the property as an owner. Transferring the right to enjoy the ownership of the property. That transfer of that right is also a transfer of immovable property. So that later on, when you sell this flat, no, capital gain will arise. What will you say? I'm not the owner of the part which I have sold. And if I'm not the owner of that part which I have sold, I've just transferred the ownership right. So ownership right I have transferred. You cannot charge tax on something which I don't own. You can you can say any type of bullshit you can say to avoid your taxes. Any type of argument, any type of logics you will come up with to stop you to give such kind of logics. We are making it very clear. The moment you transfer that right of ownership, hello, that right of ownership came because you became a member. So your membership right, your shareholding, you are transferring, meaning you are transferring the right of ownership. That right of ownership transferred, the moment you transfer it, no, we will consider that it is a transfer of immovable property only. Even if you are not the owner of that part, still this part was your owned property. We will assume it and will charge capital gain because this also is treated as transfer. Got it? Everyone? So this was the last case. Right to enjoy the ownership. Right to enjoy the ownership in immovable property. How do you get this right? You get this right by becoming a member in a cooperative society or an association, housing association. That cooperative society or housing association is the legal owner of this immovable property. So this immovable property, legal owner is this cooperative society. But that society is giving you what? Ownership right to enjoy the property as an owner. But for that, you need to become the member. So whenever you buy a flat, no, you have to apply to the cooperative society that I'm buying a flat, buying a share. Give me the right to enjoy the ownership. And that you only get if they issue membership, if they issue shares to you. So whenever that share will be issued on your name of a cooperative society, that share is as good as your immovable property ownership. And if you sell it, no, if you transfer it, it is as good as transfer of your immovable property. Even if you are not the owner of that part, capital gain will arise. Will you remember this? This was your transfer, my dear friends. Okay. End of the discussion. Transfer is over. Now, two or three small things are there. Auction sale. Whenever you see that there is an asset, capital asset sold through auction sale, don't worry, that is also a transfer. Capital gain will arise. Court judgments are there. And temporary transfer, meaning right now I am transferring my asset to you because I am in need of money, no. So I don't want to ask for a loan. Take this asset from me right now. Currently I am making a transfer, but in the agreement I am writing, whenever I'll get back that money, I'll give back that money to you and I'll reacquire the asset. So this transfer is not made permanently. This is a temporary. So what? Transfer is happening, earning money, capital gain will arise. There is no differentiation of temporary transfer and permanent transfer. Even the temporary transfers are made like this. They will also attract capital gains. Hello, sir. If there is a redemption of preference shares, there is one very famous Supreme Court judgment, Anarkali Sarabhai. In that case of Anarkali Sarabhai, it was decided, it was the judgment of the Supreme Court that if the preference shares are redeemed, so the redemption of preference shares entails into extinguishment of right in a capital asset. It is a transfer. And then only the definition also included extinguishment. Got it, sir? So if you have a capital asset and you are making a transfer also, transfer you know, capital asset you know, now you are very comfortable with these two terms. Capital asset should be there, it should be transferred, only then profits and gain will be computed, only then the capital gain will be computed. If capital asset is there, transfer is not taking place. Why are you coming here? No need to compute the capital gains. If transfer is happening, but the item which you are transferring is not your capital. Why are you coming here? No need to come here. No need to compute capital gains. Sir, if capital asset is not there, transfer is also not there, then my dear friends, you have forgotten your correct way, correct path you have forgotten. You have come to a wrong place. No capital asset, no transfer. What are you doing under this head? You are in the wrong head. Go somewhere else. Capital asset, correct head, but no transfer, no calculation. Transfer, yes, but the asset is not a capital asset. Correct head, but no computation. Transfer is also there, capital asset is also there, head is correct, computation will also happen. Now tomorrow we are going to learn how to compute capital gains. Very interesting lecture tomorrow. Okay, we are going to finish many things tomorrow. Okay, see you all tomorrow. Till that time, if you have any doubt, ask me now.